Good morning, ladies and gentlemen. I'm Rani Ali, and it gives me great pleasure to welcome you all to the New Age Finance and Accounting Corporate Tax Decoded 2023. We welcome you all as CFOs and finance heads. You are the gatekeepers of the financials, health, stability, and regulatory requirements for your organizations. You must not only have a deep understanding of financial strategy, but also the ability to navigate complex regulatory risks and opportunities. Your role is very critical to the success of your company, and particularly in these challenging times. So we're definitely here to celebrate you all today. I want to go ahead and thank our sponsors, Crow, Anderson UAE, Tax Gian, ACCA Middle East, Taxation Society, Unicus, IVES International, El Tamimi and Company, MCA Consultants, MIC Technology Services, MIC Tax Services, SBC, Tally Interwings, FAM Advisory, and BSA, definitely for showing us massive trust in our abilities and having an amazing conference lined up for today. Without their support, it would never be possible. We also have a really interesting activity lined up for you, which will take place at the end of the event, which is the Dubai Drums, so please stick around. And now it gives me great pleasure to welcome on stage for our welcome address. Let's all please invite and welcome Mr. Ravi Tharoor, Chief Executive Officer at Khalij Times. Let's welcome him with a very big round of applause.
Morning. Everybody up? Are you guys awake? Good. Ladies and gentlemen, distinguished guests, a warm welcome to the NAFA Corporate Tax Decoded, an event of utmost significance in the realm of finance and accounting. I've never seen a room full of so many finance professionals. What is the combined sense of the P&L here? Trillion? Hopefully. Today we gather here to unravel the complexities of the UAE's recent announcement regarding the implementation of corporate tax, a groundbreaking development that has reverberated throughout the business community. The introduction of the federal corporate tax system in the UAE, effective June 1st, 2023, marks a pivotal moment in the country's tax landscape. With a standard rate of 9%, the UAE boasts the lowest corporate income tax rate within the GCC region, further solidifying its position as a global business hub. In recent years, the UAE has undergone a series of tax reforms, including the implementation of VAT in 2018 and the introduction of Economic Substance Rules, ESR, and country-by-country reporting, CBCR regulations in 2019. These reforms have been aimed at aligning the UAE with international best practices and diversifying its revenue streams. With a clear vision for the next 50 years, the UAE is determined to propel its economy to new heights. As part of this ambitious agenda, the UAE has taken a monumental step by implementing a corporate tax regime with the aim to double its economy to 83 trillion, that's 816 or 817 billion approx, by 2031. The nation is steadily recovering from the adverse effects of the pandemic while maintaining a robust growth momentum. Furthermore, in December, the UAE issued the federal corporate tax law, bringing companies with income exceeding 375,000 into the corporate tax bracket. The NAFA Corporate Tax UAE Decoded is dedicated to providing invaluable insights into the profound impact of corporate tax on business operating in the UAE. Our primary goal is to equip participants with the knowledge and strategies needed to navigate this new landscape, ensuring compliance with regulations while optimizing tax efficiency. Throughout this event, we will delve into critical topics that include the implications and importance of corporate tax, implementation, operational readiness within the industry, free zones, anti-abuse rules, tax planning, UAE corporate tax laws, upskilling of regional tax professionals, international tax planning and avoidance, and much more. Led by industry experts, these discussions will shed light on the intricacies of corporate tax and offer actionable insights for organizations. As we navigate the complexities of corporate tax, this event provides a unique opportunity to connect with industry peers, engage in thought-provoking discussions, and gain valuable insight that will empower you and your organization. I encourage each and every one of you to actively participate in the sessions, leverage the expertise of our esteemed panelists, and seize this occasion to expand your knowledge, broaden your network, and drive your organization towards success. Once again, I extend my heartfelt welcome to all attendees, sponsors, and partners. Let us embark on this enlightening journey as we decode the intricacies of corporate tax and chart a path to financial excellence. Thank you, and I wish you an enriching and productive experience at the NAFA Corporate Tax UAE Decoded. Thanks again.
Well, thank you so much, Mr. Ravi, for this wonderful welcome address. The implementation of corporate tax in the UAE is of utmost importance in not only providing a vital source of revenue for the government, but also it ensures a fair and equitable contribution from businesses towards the development of the entire country. Let us now please welcome onto the stage Mr. Rohit Kajarwal, Senior Manager, Corporate Tax CROW, and Mr. Zayed Khalid Manyar, International Liaison Partner CROW, to speak about how the effective corporate tax implementation plays a significant role in fostering economic stability, attracting foreign investment, and supporting the nation's infrastructure and social programs. Let's please welcome them to the stage with a very big round of applause.
Hello. Good morning. Assalamu alaikum wa rahmatullahi wa barakatuh. Nice to see you all here. Thank you. I was asked this morning to, before I go into a technical topic, to just speak about something about the UAE and its history. So our family has been in the UAE, alhamdulillah, for 4 generations now. And in 2019, we were one of the first to receive the gold visa. But I thought, what should I talk about? And I never prepare anything. I don't have a speech written down. What should I talk about? And this morning, while having breakfast, I read Khalij Times. You're welcome. And I saw that headline, UAE most competitive in the world. Then I thought, what story can I tell you, or an actual experience of my life that talks about UAE's competitiveness? So I'll just take you back to August 1990. Yeah? I was 10 years old and stood in our balcony. The Gulf War was on. Iraq had just invaded Kuwait. There was not a soul on the street. Even our parents didn't let us go out anywhere. So all we could do is play in the balcony. There were no ski slopes or big malls, playing in the balcony. Suddenly, I hear this rumble. What happened? I look across. I see this white Mercedes thundering. We are living right on Maktoum Road. And so the tunnel comes out, straight down. A white Mercedes G-Wagon goes. And after a few seconds, more rumbling, and these big trucks go towards Dera. Anyway, I saw it, wow, impressed. I don't know what's happening, what's going on. So at that time, there was split shift, 8 to 1 and 4 to 8. So when my dad came home in the evening, I said, There was this trucks going to Dera. What happened? He said, you know what happened, son? That the money exchanges ran out of US dollar because the war started. Everybody wanted to change their dirham, get US dollar, and go. And the exchanges had run out of dollar, and there was not panic, but people were concerned. So, agility. Immediately, somebody had an idea, went to central bank themselves, load up all the US dollar we can find now, load it now, took it to the exchange. Flood the market with dollar. Whoever wants dollar, let them take. Okay, so I said, then what happened? He said 2-3 days later, the exchanges were calling Dubai police, calling the central bank. Nobody is taking dollar now. Please take it away. We have nowhere to store this much US dollar. So this shows how the UAE, how its leadership has always been agile, has always been proactive, and this is how the country remained competitive. Now, I just have a couple of slides because I thought I would take you through something technical since you're all finance people and we love numbers. One important distinction as we come into more regulation, as we come into more accountability, is this distinction between international financial reporting standards and what I will speak about next, about the international standards in audit. Now, if we divide the room of those of you who are audit professionals and those of you who are accounting professionals, you ought to be responsible for reporting. Now, why is it important? The federal laws here require you to follow IFRS. You cannot say, this is how I did it in XYZ country. No, this is the rules you need to follow. And with the advent of corporate tax, they have defined certain exemptions. Who can prepare on cash basis? There are only very few. I'm not saying that they don't exist. There are. They're the backbone SME of the economy. Even in the business section today of Khalij Times, there was a section about how the government is boosting SME, reducing costs to drive the economy. Next slide, please, Rohit. And these are some things that are applicable to people like me. We are auditors from the audit profession. I'm an ICAW qualified chartered accountant, so we are responsible for this. This means that opinion we give, firstly, we need to understand IFRS, of course, because that's what you are applying, we need to understand. But we also need to understand international standards on audit. So when you go back to your office and you call your auditor and say, time for my interim, or let's finish the year end, think about this distinction. They are expecting you now to be aware of IAS 12, income taxes. It's a standard I haven't read, honestly, in quite some time, simply because its applicability here was limited to multinationals who were having cross-border or withholding tax issues. But now it's going to be applicable to all. So with that note, won't bore you further. I know most of you stayed awake, so thank you very much. Rohit, my good friend, over to you. Thank you all.
A very good morning to everybody. Hope I am audible. A very good morning to everybody. So, before, what is the purpose of introduction of corporate tax? Why was there a need of corporate tax in this jurisdiction of UAE? So in UAE, there was earlier emirate level taxation for oil sector. There was taxation emirate level for the branches of a foreign bank. But why the corporate tax is introduced over here? So we need to go to a background over here. Like historically, UAE has always been dependent on revenue from oil sectors. So as per the IMF report of 2015, more than 95% of the revenue was derived from the oil sector. And it was stated that all the GCC countries, including UAE, should have their dependence on non-oil revenues as well. And it was specified that if the current, in 2015, as per IMF report, the fiscal deficit of UAE would have been 13% of all the GCC countries would have been 13% of the GDP. And it was recommended that all the GCC countries or UAE should have a robust corporate tax system so that they can have greater collection of tax revenues and they can reduce their dependence on the oil sector. So subsequently, in 2018, UAE became a signatory to OECD BEPS inclusive framework along with 140 other countries. What happened is that by subscribing to as a signatory to the BEPS inclusive framework, UAE provided its intention to have the international tax practices, to subscribe to global international tax practices, and to ensure that the profit is not being shifted to from high jurisdiction to low tax rate jurisdiction. So being signatory to the BEPS inclusive framework was the first point wherein UAE started its journey for the corporate tax. Thereafter, all the inclusive framework members, they have subscribed to the Pillar 2 solution. So as per the Pillar 2, there are two pillars that are prescribed there in Pillar 1 and Pillar 2. Pillar 2 talks about the fact that there should be a global minimum tax in the world. So if a country, if a foreign entity is doing operations in UAE, and if the local government is not imposing any tax on it, then the foreign nation for which the foreign entity belongs, it will be able to collect tax at the rate of 15% to it. So in order to provide its commitment to the inclusive framework member, being an inclusive framework member, UAE introduced corporate tax rate at the rate of 9% starting 1st June 2023. So why this rate of 9% was introduced? Any idea, anybody? Why not 11%? Why not 8%? Why this 9% rate was there? Yeah, that's true, because the law was also released on 9 December 2021. So, yeah, so it's a lucky, and the first metro also came on 9 September. So 9 is a lucky number for sure. Mhm. Mhm. Okay, that's also one of the reasons. But also any other views? Like as per the Financial Action Task Force, the recommendations and regulations prescribed therein, if you are having a corporate tax rate of less than 9%, 9% is the benchmark over there, less than 9% if you are having the corporate tax rate, then you will be classified as a low tax or no tax jurisdiction. So that was the reason, because of which the UAE did not go below 9%, and it got stuck at 9% because there was a reason to it, because it wanted the financial good, like to follow the protocols prescribed in the Financial Action Task Force. So that is one of the reasons for which it did not went below 9%. And it's applicable to all the entities in UAE, like all the entities are required to do the registration, the filing and all. Though the reliefs are provided to small businesses with a revenue threshold of 3 million, but still the registration requirement and the return filing requirement is there for every entity in UAE. So this is by having this corporate tax implementation, UAE has really exhibited to the world its intent to comply with the international standards, as well as being competitive in the world by offering the lowest tax rate in all the GCC countries. So this is a very milestone achievement that UAE government has done, and whatever the tax principles that are enunciated in the corporate tax law, those are all borrowed from very internationally recognized principles, so that it's really understandable to all the persons or the entities across the globe. There is relief provided to the individuals as well. Individuals having a turnover of up to 1 million, they are not required to register themselves, or they are not required to file the return of income. And also the real estate, one of the most important thing is the real estate, and still the real estate income in the form of rental and the sale are all been outside the ambit of the corporate taxation for the individuals. So that is again one of the important aspect. And going for the applicability, it's applicable for tax period commencing on or after 1st June. It means that if your corporate tax is your financial year starts from 1st January, so the first year of implementation of you would be from 1st January 2024 onwards, not 1st June 2023. However, whatever the things you are doing after 1st June 2023, you have to be very careful with it to comply with the various aspects of the tax law. So what was the introduction purpose of the corporate tax? It really cements the UAE position as a leading global hub accelerate the development, and reaffirm its commitment to meeting the international standards for tax transparency. And the tax is levied on the profits earned from the UAE-based operations, and businesses are required to file tax returns annually to comply with the various aspects of the tax law. The compliance that is there from a corporate tax perspective, it's only annually, and there's no advanced tax withholding as of now in the UAE corporate tax, but that's just the time, and we hope that the same would be there during the international tax transparency. So this is the framework of the transparency of what the UAE-based in terms of implementation of the tax transparency annually to comply with the aspects of the tax law. Compliance that is there from a corporate tax perspective is also annually, and there's no advanced tax as of now in corporate tax. That's just the time, and hope that the same will be the tax transparency. This is the framework of the profits from the UAE-based operations and to comply with the aspects of the tax law. Compliance that is there from a corporate tax perspective is alternate dispute resolution. So, and after that, in 2018, the government has also signed with the OECD Model Tax Convention tax treaty-related measures to prevent base erosion and profit shifting. Thereafter, in 2018, there was also introduction of VAT that was done, which was also a significant milestone of shifting to non-oil revenue. And also from 2019 onwards, there was economic substance regulations that was introduced in UAE along with the requirement of CBCR reporting. Why is economic substance very much essential is that there were many companies who were deriving revenues from UAE, but the revenue were not commensurate with the level of economic activities that were being carried out. So it becomes very important that whatever revenue they are having, that should be in synchronization with the level of activities that they are doing. And by doing all this, the UAE has enhanced the tax transparency and addressed the gaps in the tax rules. So these are some of the points to ponder regarding the corporate tax that is there. I believe all the esteemed speakers would cover in detail in the subsequent slides, but I just like to just touch upon a few base points for all these points. First is the gearing up for the corporate tax law. So although for most of the entities, the corporate tax is implemented from 1st Jan 2024 onwards, but the preparation for it should be made from 2023 onwards. Now, why is it so? Because there is a requirement of transitional provisions, Article 61 of the corporate tax law, which states that all the related party balances should be benchmarked as per the arm's length price in the closing balance sheet. So that becomes very important that whatever related party balances are appearing, that's a benchmark to the as per the arm's length price. Also, whatever the positions that we are seeing right now, like the after 1st June 2023, whatever the positions we are saying, the adjustments we are doing in the accounting system, we need to see that whether the same is in synchronization with the tax law, and there is no red flags that we are doing in the system, so that there should be a robust internal system to ensure that whatever we are doing, that is in alignment with the corporate tax law. The second is the taxability of the free zone entities. Now, the taxability of the free zone entities has really opened a Pandora's box now, and there is again a lot of requirements from a substance perspective and what would be qualifying income and what not be qualifying income. And we believe that a lot of free zone, like free zones were formed with the intention free zone regulator has said that the free zone entities would be deriving a tax holiday. So there is a lot of hue and cry in the market that what will happen, whether a ministry will come with a new list of free zone or whether we need to seek clarification from the free zone regulator as to whether they would be falling under that or not. Then is the implications of the permanent establishment. So the concept of permanent establishment is really a globally vast concept, and there are a lot of issues that are arising in the permanent establishment thing. So whenever a foreign entity is operating in UAE, it needs to ensure that its operations are carried out in such a way that it doesn't trigger a potential PE implications. So in order to that, you need to have sufficient documentation in place so as to alienate your activities in such a way that whatever activities you are carrying out is demarcated from the activities of the foreign entity. So that again is very important. Then going for the deemed residencies is a GAR. So many a times what we have seen that the entities in UAE are managing the operations of entities outside the UAE. So although the UAE-based entity, the director of the UAE-based entity are managing even the operations of Saudi entity, operations of India entity, so what is the potential risk in that? There is a lot of risk that if the strategic decisions of the outside entity, outside UAE entities are taken from UAE, then it may trigger a residency for that foreign entity over here. So we need to, and the foreign entity would be required to comply with all the tax obligations in respect of corporate taxes, which is applicable for resident. So whenever a UAE entity is managing the operations outside UAE, we need to be ensured that it's carrying out operation, like the housekeeping measures are in place, so that the board of meetings and all are sufficiently carried out outside UAE as well. Then the general anti-abuse rules. So the general anti-abuse rules, I believe everybody must be aware that whatever restructuring or that we are taking place after 1st of 25th October 2022 will be subject to the GAR provisions. It doesn't mean though the corporate tax law will be applicable from January, but the GAR provisions are applicable as on date to us. So whatever transaction arrangement that we are doing, that will be subject to GAR provisions. And if it's arriving, it's any corporate tax advantage, then it may be lead to a substantial adjustment to the entity. So what is very essential in this, that it gives unlimited power to the tax authority. So whatever transaction arrangement that we are doing, post the corporate tax is implemented, that we need to do within the four corners of law, so that there is no potential adjustment to the taxpayer in future in the tax authorities. So we need to be mindful that many a times the client come to us and say that, okay, we have sufficient amount of time, we want to do some adjustment in the book, we have to see the transactions, we have to, so that we can enjoy free zone exemption, we can enjoy the taxable limit exemption. So all those kind of things needs to be studied in detail, so that it may not, what can seem lucrative now may not seem a botheration for the client in future. So that needs to be seen in detail. The transfer pricing consideration. So whatever transactions are happening between the related party, that needs to be at the arm's length price. Also, although there is a relief provided in terms of the TP documentation as to the threshold of 200 million dirham is prescribed and part of M&E group, but the compliance with the TP consideration, TP obligations needs to be done by each and every entity in UAE. Now, this is a very issue over here, because even if you are carrying out transactions between two domestic entities, and there is no tax leakage, there is no tax arbitrage, but still there is a requirement of having the arm's length pricing between two domestic entities. So that is very much important to be considered, and we may see a relief or any decision in respect of that, because it will just improve or increase the compliance burden. And allowances and disallowances. So there are many allowances and disallowances prescribed under the corporate tax law, which we need to be mindful of, because the tax at the rate of 9% is levied not on the corporate, the accounting profit, that is levied on the taxable profit that is arrived after making adjustments as per the corporate tax law. So there are certain issues which are still awaiting clarification, like the depreciation rate under the corporate tax. What will be the depreciation rate under the corporate tax? Because till now, there is whatever the rates have been prescribed from the accounting perspective, that will only be followed from the corporate tax. We need to see, and it will be only time will tell whether a separate depreciation rate should be coming for corporate tax or not. The high sea sales for free zone. So now, free zone, we still awaiting what will happen from goods which are like importing from outside UAE to outside UAE is going, and there's no, the goods are not importing to UAE, then what will happen to that from a free zone perspective? Now, permanent establishment disposal test. So in the ministerial, the guide that was released subsequently, it was specified that the disposal test needs to be carried out for need not be carried out for a reasonable period of time. Now, what that reasonable period of time means, because this is something which is not there in other jurisdiction, and that needs to be seen whether how it evolves in due course of time. And the benchmarking of managerial remuneration. So this is a very important concept, because the payment, whatever is made to the managers, directors, are covered under the ambit of Article 36 of the corporate tax law, and even the word officers are prescribed over there. So who all the officers, whether the officers should be CFO would be constituted as officers, whether the finance directors should be constituted as officers, whether the marketing directors should be covered as officers, that needs to be seen, and there needs to be benchmark, and how the benchmarking needs to be done, that also needs to be seen, because the benchmarking of managerial remuneration would be very much difficult, given that it's very difficult to attribute what efforts a manager is providing, or what of efforts a director is providing to the organization, because it's very factual basis and depends on fact-to-fact basis. So I think is there for now. Thank you.
Well, thank you so much, gentlemen, for highlighting the inevitable reality that corporate tax is. Let us now move to the first panel discussion of the day on operational readiness within the industry. As we navigate the complex landscape of corporate tax, we will delve into the key aspects, challenges, and the best practices of operational readiness, equipping organizations with the knowledge and tools to adapt, comply, and thrive in an ever-evolving tax environment. Let's all please welcome our experts onto the stage. We will start by setting up the stage. Few seconds. Yeah. All right, so on the presentation of corporate tax and inevitable reality, we have our speakers, Rajiv Thakar, Audit Manager at Jitrade Consulting Group, and we have Shitin Mandani, Audit and Tax Consultant at Jitrade Consulting Group. Let's all please welcome them to the stage with a big round of applause.
Very good morning to all. The corporate tax, inevitable reality. If before 6 years or 7 years, if anybody who could have thought that in the UAE we will see corporate taxes or the taxes started with the indirect taxes of excise and VAT, and now from 1st June 23, this corporate tax is already there. We are already sitting in the corporate tax. Nevertheless, for many of the companies who are following Jan to December calendar year, for them it will be from 1st Jan 2024. Now the corporate tax federal decree law came in October 2022, but unlike the VAT, in the VAT we have received the executive regulations, but the authority did not wanted us to go through that pain of reading 60 pages and searching what we need in an executive regulations. They will come up with the separate regulations on each and everything separately, and that gives us the flood of the Federal Tax Authority decisions, cabinet decisions, and many ministerial decisions. So the corporate tax, we all know that 375,000 dirhams is the 375,000 dirhams is the base limit. If your net income is above that, then only you are paying 9% corporate taxes. So without going further into the basics, let's come to the specific topics. The first thing we have taken is GAR, General Anti-Abusing Rules. Because under the corporate tax, we should know what we should do, what we should not know, what we should not do. Because under General Anti-Abusing Rules, as my colleague from Crow has already explained, that if any kind of transactional changes or the legal changes done to have any kind of a tax advantage, on that the authority has got the full power to nullify those changes and add those kind of profits or taxes in the entity's profile. But in this, there is also one that even if you are doing something, any kind of transitional changes or the legal changes, which has a business decision or the managerial decision, if you have the business advantage will not be considered as a tax advantage. Moving forward, we have the tax group. In the tax group, the first condition, although we have mentioned at the very bottom, but the first condition we have to understand is that there has to be a relationship of holding and subsidiary. The holding company must be holding at least 95% of the shares of the subsidiary companies. 95% shares of the subsidiary companies. In UAE, if we divide the corporates or the groups in the two brackets, the one bracket is following this kind of holding subsidiary concepts. But there is a major part of the groups or major part of the SMEs who are not following this kind of a 95% holding strategies. So this will not be very much advantageous to the public as a general or public as a whole. Apart from that, even in the VAT, we know that the grouping done under the VAT for the tax group purpose are not similar, are not applicable automatically for the corporate tax purposes. Now, going into the much detail, the companies or the entities which are coming under the tax group should be judicial persons, should be the resident persons, should not be exempt or qualifying free zone persons, because if you are a qualifying free zone person, then you are already claiming 0% corporate tax. So they are not allowed to enter into the tax group. You must be following the same financial year and the same accounting standards, as we all are following IFRS in the UAE since many years. And the groups are already following same financial year for all their companies and same accounting standards and same accounting policies for all of their group companies. So this we are already following, but yes, it is defined in the law. And the most condition is the 95% shareholding. Moving next, let's understand what are the advantages and disadvantages. The first advantage is that we are free from arm's length principles. Free from the arm's length principles and the transfer pricing documentations. At presently, the transfer pricing is the hot topic in the UAE, because ultimately to implement the transfer pricing, there are many obstacles, like how to get the uncontrolled price method, or how to verify that the rate on which you are selling to your related parties are at the arm's length or not. Or like say, the managerial remunerations you are paying to your directors is at the arm's length or not. Another one is that the losses of one company can be set off in the same year with the other companies, which is directly giving the cash benefit. And lower compliance burden, as we have only the one single corporate tax return. The main biggest disadvantage what we see is that being a corporate tax group, you will get only one exemption limit, that is only 375,000. Let's say with the example we are explaining the next slide, and you are compulsorily required to do the consolidated financial statements, which anyways at presently many companies might be doing as per the IFRS. So let us understand the tax group with an example. At here we have drawn that A, B, C, three companies separately, and the tax group as a whole also. Without going much in the detail to the example, if I can say that the corporate tax for the individual company, if I total, it comes to 11,250 dirhams. And also for the three companies individually, they are able to carry forward losses of 200,000 dirhams. But if they are under the tax group, their tax liability will be 20,250 dirhams. So this gives me directly a disadvantage of 9,000 extra paying of the corporate tax and not carry forwarding the losses to the next year. This is because mainly, if we see in the second line that the basic exemption limit is each company, if we take, comes to 1.125 thousand, but as a tax group, we are getting only one tax limit. Nevertheless, the tax group decision cannot be taken based on this simple example or based on these advantages and disadvantages ultimately we have to see the cost benefit analysis. The cost of a cost of maintaining arm's length principles, the cost of maintaining the arm's length documentation, and the benefit of the tax, what we may pay less or high. Now the qualifying free zone person, same as VAT, the authorities has given us this treasure in the last, which we received in June 2023. This month itself at the start. So let us understand that who are the qualifying persons and how they can claim to be qualifying person. So first condition they have mentioned is the maintain adequate substance. Now the adequate substance meaning to us is not new because we all are under the economic substance regulations era. So we know that and what conditions are there under ESR. The similar kind of conditions are put on in the corporate tax also. So maintain adequate asset, adequate number of qualified employees, and incur an adequate amount of operating expenditures. Now, derive qualifying income. Now, what are those qualifying income? We can understand in the next slide. And next is they has not selected to be subject to corporate tax at 9%. Obviously, if you want to go under 0%, you cannot select 9%. Still, they mention in the law, and they must be complying with the arm's length principles. And they have to prepare the audited financial statements. Now, at here, before we understand this further, let's first know that if they fail to meet this qualifying free zone person conditions, what will happen? They will be paying 9% tax for the current year plus 4 years forward. So ultimately, for the total 5 years, they will be paying 5% corporate taxes. But at here, one more thing is there that if you fail to maintain a qualifying free zone person, okay, you're paying taxes at 9% for 5 years, but again, in the 6th year, again, you can go and you can check your books of accounts, check your company. If you are again qualifying for the qualifying free zone person, then again you can come for 0%. It is not that once you are out from the qualifying free zone, you cannot come in. It is the every 5 years plan. I'll say that. The same thing which we discussed, which we put in the diagram, the conditions are same, derives qualifying income, have adequate substance, comply with the arm's length principles. And at here, one thing I would like to mention, de minimis requirements. Now, what are the de minimis requirements? The de minimis requirements are there that if a company is getting a revenue of 5% for the non-qualifying income or 85 million, the authority very well understands that any person who is doing the business will not have only 100% from the qualifying income. They would have something from the non-qualifying income or the excluded activities, which may not be direct, but may be incidental to the business. So they kept this limit of 5%, that even if you are earning 5% of non-qualifying income, you are still maintaining your qualifying free zone status. Now, the qualifying income, let's understand through this, that income from transactions with other free zone persons, except excluding activities. Income from transactions with other free zone persons. So if one free zone is transacting with other free zone person, yes, that will come under a qualifying income, but that should not be the excluded activity. And the other one, income from transactions with non-free zone persons. Now, income from transactions with non-free zone persons, let's understand what is non-free zone persons. Now, let's say for a Jabalali free zone company, Javza company, the non-free zone persons are mainland and outside UAE. This is what our understanding is. So in this, if a Javza company is dealing with any mainland company, they are covered. In this, if a Javza company is dealing with any outside UAE company, or they are into the high sea sale transaction, so as far as those all kind of transactions are covered at here, because They have said, they have specifically excluded only one thing, non-free zone person. So whatever you are doing other than non-free zone person will all come under this level. So income from transactions with non-free zone persons will qualify as a only qualifying activities. Now, these are the qualifying activities. Now, in this, I'll not go in much detail, but I'll just touch upon this distribution of goods or materials in or from a designated zone. Now, again, continuing my example for the Javza, that if a Javza company is selling to a mainland company, and a mainland company being an importer on record, the Zavza company still continues to get an 0% exemption, 0% qualifying free zone person. The other activities are almost in general, or I can say a few: manufacturing, processing, holding of shares, reinsurance, wealth and investment. Moving forward, what are the excluded activities that if a free zone person is doing, they are straight away coming under 9% taxes. The excluded activities are banking, insurance, but the reinsurance they have put under the qualifying income, finance and leasing, ownership of immovable property, and ownership or exploitation of IP assets. Now, if a free zone company is doing any of these transactions, are covered under the, are straight away paying 9% corporate taxes. From this next presentation, I'll request my colleague, Mr. Chetan, to take over. Thank you. Thank you from Taxian.
Thank you, Mr. Rajiv. Good morning, everyone. So now moving to our next topic, small business relief. As we understand that the small and medium-sized enterprises are the backbone of any industry, any economy. So considering this fact, UAE Ministry of Finance has also given some advantages to small businesses. So what is the small business relief? So small business relief means the person coming under the small business relief conditions will not be paying any corporate tax for the 3 years period. So what are these conditions? The first one is during the relevant tax period or the previous tax period, their revenue should be below 3 million dirhams. And there are certain conditions which they need to meet to claim this small business relief. The first one is registration is mandatory for them. Second one is corporate tax return submission is also mandatory for them. Then this revenue should be revenue should be calculated as per the IFRS standards, and any qualifying free zone person will not be able to claim this relief. And here the highlighting point is that if you are claiming this small business relief, you will not be able to carry forward the losses incurred during this period. So that means when you are filing the corporate tax return, you need to check whether you have incurred any losses during this period. If yes, better to not claim the small business relief because that will give you a disadvantage of not carry forwarding these losses. Now moving to our next slide. We have the transactions with the related parties. So in short, all the transactions or any arrangement with the related parties should be at the arm's length price. What is the arm's length price? In a common language, we can say that any transactions carried out with the related parties should be at par with a transaction with the third parties. And how can we calculate this arm's length price? Here we have the 5 methods, but due to the time constraint, we are not going in depth. Moving to our next slide, we have the transfer pricing documentation. So UAE has given an exemption if your total revenue for the multinational group is below 3.15 billion dirhams, or your UAE company's revenue is below 200 million dirhams, then there is an exemption that you not need to maintain any transfer pricing documentation, that master file and local file documentation. But still, we suggest that you should maintain this document for the future references. And when you are submitting your corporate tax return, you need to you need to file a disclosure regarding the related party transactions as well as all the connected person payments. Moving to next slide. Payments to the connected persons. So any payment or the benefits provided to the connected person should be again at the market value. And who are these connected persons? So here we have the list: owner, director, officer, and a related party of these officers should be covered under the connected person. This is a broad definition, so we need to consider who is the connected person for the company before entering into any transactions. Now we have the deductible expenditure. So interest expenditure was one of the key highlight for the deductible expenditure, but now FT has clarified that if your interest expenditure is below 12 million dirhams, then you can claim the full interest expenditure, and if it is if it is above 12 million dirhams, then it will be 30% of EBITDA. So you can have a look at what is included in the interest expenditure. This is the list. Here the key point is that any finance element of the lease transactions, finance lease as per the IFRS 16 is also covered under this interest expenditure. Entertainment expenditure, any expenditure incurred for the shareholder, supplier, customers will be deductible at flat 50% rate, and 50% will be disallowed. What is the administrative compliance is already almost covered, that you need to do the mandatory tax registration and deregistration within the 3 months of dissolution or liquidation of the business. And then we have the books of accounts. You need to maintain the books of account as per the IFRS. And for the below 50 million revenue, there is an exemption that you can go for the IFRS for SMEs. And if your total revenue for the year is below 3 million dirhams, then you can also adopt the cash basis accounting. Audit requirement for the turnover above 50 million dirhams is mandatory for all of them. And if you are a qualifying free zone person and you are claiming the 0% tax benefit, then also the audit will be mandatory. Now just have a look at these takeaways. Thank you, everyone. Thank you from Tax Gyan.
On your presentation on the corporate tax, the inevitable reality. We will now move on to the discussion titled Operational Readiness Within the Industry, the discussion on the key aspects and challenges related to the operational readiness in the industry, and sharing of industry-specific insights, experiences, and best practices, and how should corporate prepare for this important change in compliance. I'd like to invite our panelists onto the stage. Let's please welcome our panelists. We have Naveen Sharma, Chairman, Taxation Society. We have Rajini Ravi, Global Head of Finance Operations, Inchcape Shipping. We have Rajiv Thakkar, Audit Manager, Tax, GN. And we have Samruti Mishra, Manager, Financial Reporting, Etisalat Service Holding. And I want to welcome our moderator, Nimish Makavana, Senior Partner, Crow UAE. Let's keep all our questions ready for this amazing panel, and they're going to be taking the questions at the end of the panel. And I'd like to invite our wonderful attendees to please move a little bit forward to the first line, if you can, please. That would be amazing. Let's now give it to our panelists.
Good morning, everyone. Hope I'm audible. Great. June 1st, 2023 is the historic date for UAE. I'm sure you all agree with me. The tagline, tax-free economy, is no longer on UAE now. With robust compliance and regulatory framework, I'm sure in times to come, we'll able to see the growth in this beautiful country. We must applaud the leadership of UAE and in particular to Dubai for giving this platform to all the business houses for the opportunities and the growth in this part of the world. Before I start on panel discussion with my panelists, I would like to compliment Khalid Times for this initiative and having this in-person and online corporate tax UAE decoded event in such a short span of time after the effective implementation of UAE corporate tax. I think so, Khalid Times deserve a big round of applause. With corporate tax law published, various ministerial decisions, cabinet decisions, along with explanatory guidance are already published. And we have with us expert panelists from the industry, local group, as well as the corporate houses. They are here to share their experience, to share their knowledge, wisdom, and operational readiness within the industry. So let me start with my panel discussion. First, Rajni. Rajni being a global head of finance operation, Inchcape Shipping. Rajni, this Inchcape Shipping is a global British multinational ports and marine management headquarters based in London, across the globe in more than 60 countries, 245 offices and all. You being the global head of finance, what are your thoughts on operational readiness for the new tax regime? What should the business be doing to get themselves into a state of preparedness? I'm sure you might have, within your group, seen other jurisdictions where already tax is there and how the effective implementation is happening. So if you can throw some light.
Very good morning to all of you. I take from what you said, we are lucky to have a global presence in over 60 countries, and that means we have a very mature tax function. We have recently, 2 years ago, implemented a major ARP onboarding, where we had to pay special attention on development of tax tools for various complex tax regimes like Italy, Brazil, or even India for that matter. And that has stood us in good stead in preparing ourselves to onboard the UAE corporate tax. And having said that, I have headed a few transformation exercises in my career myself. And there are some basic aspects that we always pay focus to, which has helped us do the transformation successfully. And the corporate tax is by far the biggest transformation that businesses will have to undergo in this jurisdiction. I call it the basic principle. First is the business impact assessment, which I'm sure most of my esteemed industry leaders in this gathering would have already done, because we have had almost a 22-month heads up from the government, and they have been extremely helpful in issuing guidelines and ministerial decisions to help us get a stable knowledge base as to what is expected from the tax administration. And the second one would be the accounting and reporting requirements that has been set out in the guidelines. And quite a few of my peers have already set out what would be the strategic decisions that we need to undertake based on tax grouping, tax residency, or even in the accounting matter, creation of a new chart of accounts or tax codes, nominal codes. So, and the third aspect I would say would be the system readiness. I can't stress enough on the importance of having a digital infrastructure in place. And we all know that it takes a bit of time, lead time in building and designing that system that is most effective. And I'm sure most of us are already on different stages of that journey down that road. The next one would be the intercompany or the intra-group transactions, which my colleague has already touched upon. The ministerial decision has come out on the transfer pricing documentations, and that is something that we need to evaluate and as to how we structure our business going forward. And last but not the least is the compliance. And on that, the change management rests on three big pillars, which I would say is people, processes, and procedures for governance. So as far as people goes, there are different routes that you can take. Either you can develop your in-house expertise, or you can rely on external expert guidance, or best would be the hybrid of the two. And on the processes and procedures, I think a governance model is extremely important to make sure that you are prepared to deliver on what is expected of you from the government.
Thank you. Thank you, Rajni. It is quite insightful. I would like to go to our next panelist, who is expert, Navin Sharma, who is a part of Al Shirawi Group. I'm sure that most of you must be aware about Al Shirawi Group existence in this UAE 1971, and more than 100 plus companies he is managing. So Navin, my question to you is, we are already in the 6th year of VAT. In your experience, how different the corporate tax implementation will be compared to VAT implementation? And can you also share your learning from VAT implementation, which will help you in corporate implementation? And just to touch upon, because most of the organization, the year end is December. Like everyone follow calendar year over year. However, Navin, your group follow 30th June, and effective from 1st July in few days time, tax applicability will be there. And I'm sure you must be well prepared and everything is ready. I'm sure your experience is going to be quite enlightening. Navin.
Good morning. First of all, I would like to say that whatever I say here, this is my personal view. It is not the official or the views of my employer. So please keep this in mind. First of all, what we see is a 5-year. If we see 5 years back, VAT is implemented in this beautiful country. And now we are implementing corporate tax. I can also say that after 5 years down the line, maybe we have to do the pillar 2, because the kind of size my group has, we have to implement pillar 2 as well. So VAT is a quite different. It is indirect tax, and it is a tax on transaction. So every single transaction is covered. And think about 100 companies in 20 different lines. Each and every transaction, we have to ensure that it is compliant with the law. And then we have some advantage because the group is one, because the grouping requirements were pretty simple. It took a lot of time, a lot of hit and trial by way of making mistakes. We have not perfected, we have improved. Giving you the example, whether the exit certificate is required, what kind of documentation is required. But during the last 5 years, everything is over. We have audited by the FTA, then we have revised our returns. So many different things we did as of now. Now, first thing and the most important thing is that what my learning is that you have to have your systems right. Systems right means that the information should come from your ERP system, your IT system. Laws are very simple here. what we have to see is that the UAE government has not imposed any undue compliance. Say, for example, Article 32, entertainment, 50% is the limit. But the problem with us is that find out the actual entertainment expenses. If you are in the industry or doing the audit, some are going in office expenses, some are going in miscellaneous expenses, some are going in entertainment expenses, some are going in staff expenses. So across all the group companies, getting the information right is the key. If you have the right information, and I think half of the work is done. The first thing that we have to see is that we have to have the good IT system. Data entry should be as clean as possible. Second is, what we have done is that our return should come directly from the system. As far as possible, so what we did with the help of, we have Mr. Anurag Chaturvedi, we have Mr. Neerav Bhai, who have helped us, that this is the return which we have to file. And what I did, I have just given it to the IT department. I need this data in the same format which we have to submit to the government. So now, when we did this, then we came to know we are not punching a lot of data, we are punching the wrong data, and so many different things were happening. So the one advice from my side I want to tell you is just give the end return as your another Oracle report or the SAP report. Then you will come to know what are the gaps. The issue is that we always try to make the VAT return or CT return from Excel. So that is the way it is. Third thing is transfer pricing. I think transfer pricing is a key because the CT groups will be very different than the VAT group. So in the industry now you have the IFRS group, you have the VT group, means VAT group, now the CT group. So we have to design the system and people should understand what group the CT group is different. So the Article 34, 35, 36, 55, 56, 61, all is very important. And I think what is more important is the 61, transitional rules. People think that new year is started, but I think now the government has made it clear, even the opening balances has to be on arm's length. So we have to ensure that we have the right system, right data entry, and just ensure the compliance. Do not try to find out how I will save the tax, whether this is right or that is right. The law is very simple. Compliance is the key. You can file whatever you want to file today. But when the audit will come, then you will see whether you have filed the right data or not. And try to have as much as possible data digitally. As we have the data digitally, and then we can retrieve it very fast. So these are the few takeaways I can see from the past we can implement. And when you implement and you feel in the future, the Pillar 2 is coming, think about the Pillar 2 also. That when the Pillar 2 will come, not only the global tax rate will go to 15%, not 15% because you have number of other rebates, so effectively it is around 10%. What kind of documentation is required? So if you think, learn from the past, act what is required in the present, and think about the future, I think you will take care of your employer and in that sense, yourself. Thank you.
Thank you, Naveen. I think so briefly you covered very well. And as you rightly mentioned, data is very important and the system should be in a place. Smriti, who is the manager financial reporting with Etisalat Service Holding, and as we all are aware, Etisalat Service Holding is a part of E-End with a revenue of in 2022 was 52 billion. Smriti, my question to you, what are your thoughts about the challenges organizations face when striving for operational readiness? What approaches have you found most effective in ensuring this readiness for corporate tax compliance? I'm sure because you are part of MIS reporting, you will be able to add a lot for our audience.
Thank you, Nimish, and good morning, everyone. Like Mr. Sharma said, even my views here are my own and not that of my organization. But having said that, I think in terms of challenges, that we first noticed was, of course, a knowledge gap. Because a lot of us, or most of us, have studied taxation or its accounting in theory, but living in this part of the world for the past so many years, we have perhaps not practically implemented it so far. So I think it was Abraham Lincoln who once said that if you ask me to chop a tree and give me 6 hours for it, I will spend the first 4 hours sharpening my axe. And I think that's exactly what we need to do right now in terms of planning. So I think the first challenge would be this knowledge gap, where we need to identify gaps in our talent, in our expertise, in our teams, and then find ways to plug those gaps by way of training or upskilling or even outsourcing. IAS 12, for example, income taxes, we've all studied it, but perhaps not practically implemented it so far. So that's something we need to brush up on, and the time to do that is now. And the second challenge, I think, is around a lack of clarity. I think when any new regulation comes in, that's always going to be the case. The laws and regulations are very dynamic. They keep coming in as time passes. And like Mr. Sharma said, even when VAT was implemented, it took a few months for certain clarifications to come in. Even when the first round of audits were done, I think those were as much a learning experience for us as they were for the authorities themselves. And that's an inevitable challenge when any new regulation comes in. So I think an approach to sort of mitigate that or manage that would be to have a very responsive and adaptive organization, like Rajni was saying, in terms of people, processes, as well as systems, so that we can adapt and keep in mind forums like these or FAQs, clarifications from the authorities, and maintain an open channel of communication with the authorities, because I think we are blessed in this part of the world that the authorities are very responsive. They believe in two-way communication. They are approachable. And I think we should make use of that for any clarifications or information that we need from them.
Thank you. Very well said, Smriti, that skill gap is quite high, and it's very important that everyone has to go through very carefully what has been stated in the law and no need to read anything in between the lines. Rajiv, now I would like to come to you. Rajiv, you being an audit manager with Jitendra Consulting Group and providing services to the many business houses in UAE, the landscape of corporate tax compliance is constantly evolving. With new regulations and requirements being introduced, it is crucial for organizations to be prepared. We would like to hear your recommendations on how corporate entities should approach and navigate these changes in compliance effectively, because we are seeing year after year, month after month, various changes are coming, various new laws are coming. So how to cope up with that?
Thank you, Nimishji. At here, first, I would like to divide the UE entities into the two groups. First is the M&E groups, like Rajni's group, like having 60 countries set up, or Mr. Naveenji's company having like 100 companies. Like those companies will be having a good IT infrastructure, good employees, good human intelligence. So for them, it will be like not easy, but it will be for them a good part to implement the corporate tax or the VAT or anything. But apart from that, there are many taxpayers or the many companies who are coming in the second group, which are like not like multinationals, but which are the backbone of the country. They are not having good IT infrastructure. Even if nowadays there are many companies who are still doing their accounting simply on Tally, not even on the ERP. And moreover, we have seen since last 6 or 7 years, the many taxes are coming, starting with excise, VAT, anti-money laundering, economic substance regulations, CBCR, UBO, and then now corporate taxes. And for this kind of compliance is increasing day by day. If we see, every year we have something one new on our table. So for this purposes, all the companies first should have the human intelligence. They should have the proper employees in their portfolio who can take care, who is having the knowledge of all of these taxes, and they implement it properly. because ultimately what is happening that the companies are implementing, even the VAT and excise and AML, everybody has implemented, yes, but ultimately at the, when the time comes, when the authority comes in, they are gone with the high amount of penalties. So to implement is one thing, and but to comply with the law is completely different. So I'll say that the companies should much invest on the human intelligence and on the IT infrastructure. Thank you.
Thank you, Rajiv. I think so very rightly said, the non-compliance cost is very high. So make sure that you invest in compliance and avoid any kind of penalty. Uh, I would like to now go to Naveen, and I'll just request all the panelists to be very brief because we have a short of time and we want to take the question from audience also. Naveen, being a part of Al Shirawi Group, what is your take on tax grouping and how you as a group will benefit from it? And while tax grouping, how the transfer pricing documentation and the implementation will be there, if you can touch upon very briefly.
Thank you, Nimesh. Transfer pricing is key because the rules, we are waiting for the disclosure form, we are waiting for some other regulations to come. But if we see the Article 34, 35, 36, 55, one thing we have to also go in deep. If you have a tax group, there is no need for transfer pricing is a wrong concept. Because you have to think one day you may take out one group company or may merge with somebody or you can sell. In this situation, you have to ensure the losses of that particular entity. So we have to go deeper. And we should not be just think, okay, if we have one tax registration or we have only one tax group, there is no transfer pricing. We have to see the fine numbers. We need, personally, I think to serve our organization well, we need to have the mentor who can, even if you are driving a car, somebody should answer. And I think one person stand out is Rajiv Hira. So whenever I am calling him, so he can say that first you have to memorize the section, article, and you have to understand that you have to go beyond and think the company may be exit, company may enter, then what will happen? So when you design your systems, you have to see one company, whether even if it is a part of the tax group, we need to ensure that only this company no documentation. Even if it is in the same tax group, I think considering that we may sell this company in future, it may merge with something else, then we need to have some documentation. So that is the key. And transfer pricing is the only one aspect. We have to go and divide into number of different aspects because the time is short, so I will not take much time. Then we have to see the cost, how we allocate our cost, how we charge our PRO cost, and so many different kind of categories which we have to create. And of course, always remember, transfer pricing may not be applicable, but Article 34, arm length, is always applicable. Thank you.
Thank you. Thank you, Naveen. I think so deep diving is very much required with respect to every aspect of the law. Rajni, with respect to technology and automation, I'm sure that global presence is there. So what kind of infrastructure you are developing and or you are using which is already built in by the group to cope up with corporate tax in UAE?
I think Naveen made an excellent point about making the system work for you and not having to do any manual process around the data capture. I think that has to be the main driving goal, that whatever data collation and processing is required for compliance with the corporate tax, that you incorporate it in your system design. This would call for certain amount of redesigning of your existing systems and processes in your current landscape, but that is where the preparedness comes in. And if you put in this effort one time at the beginning of the corporate regime coming into place, then I think your life onwards will be easier. There are n number of tools that are available in the market right now, starting from big data, AI, cloud computing, and Internet of Things. But it will be a bit far-fetched, like Rajiv said, not everybody is in the same digital maturity space. We'll have to look at small and medium establishments where easier thing to do would be to use something as simple as AI bots to automate some of the routine work that you do, be it in the billing process or in the capture of tax information on invoices, so that it's easier for you to automate going forward. So it's one step at a time, but I think technology is certainly here to stay. The two main areas of benefit realization would obviously be in data processing and also in setting up a digital tax governance, which would give more visibility to the senior leadership in the organization on the tax status, the refunds, the tax losses position, etc.
Thank you. Thank you, Rajni. Smriti, if you can just briefly touch upon what will be impact of corporate tax on your financial and management reporting?
I think one of the earliest things that we started off with is a bottom-up approach rather than a top-down one, just to see that if results remain as they were, then what sort of impact of corporate tax we would see. And the idea, of course, is not to be cheeky, but to just find out where the gaps are, where we have any inefficiencies, and how we can help bridge those when the law actually comes into effect. So that, I think, for any financial or reporting team is key, to give that strategic direction to your management in terms of how you can bridge those inefficiencies. And the second, like I mentioned earlier, I think around IAS 12, both in terms of its accounting, like taxable, your tax expenses, incomes, recognition and measurement of deferred taxes, is all something that most of us in this part of the world had not done so far. They also have a very extensive set of disclosures for your financial statements. So that's something I think we all need to brush up on now, so that we are well prepared before the next year begins.
Thank you, Smriti. I think so. Clock is ticking here. It's a time for the audience. Maybe can I request to take at least one question from the audience, and then we can wrap up this panel discussion. Yeah, over there. Due to shortage of time, we're able to take only one question, and panelists are over here. So after the session also, you can get in touch with them.
Hello, am I speaking through the mic? Yeah, this is a question relating to transfer price, I suppose. We have two entities. After this new tax law came in, last year we created two entities, mainly to distinguish the verticals clearly, one security, other auto ID, something like this. Okay, and while doing so, even as we do it, some of the quotations we have given for AMCs or for the requirements, the clients have originated their LPO, okay, their purchase order, in the earlier entity. And there are some administrative problems in registering the new entity. So therefore, we had to bill it in one, transfer it to the other, because of the operational challenge. Nothing to do with violating any of the principles or the integrity of the system. So what do we do here? Because I can't add some price to it. The margins are low. So what kind of consequence I can expect out of it? Hope question is clear.
Yeah. Naveen will throw some light on it, although it is quite specific. Without review of the documents, it's not possible, but Naveen, please.
So basically, you have, what I understood that you have two tax registration, A and B, and contract or AMC is given for both, and it is in the name of one. It is very simple. If you can do, you can give a letter to your AMC provider, and you can say that divide 50-50. So instead of one, and then he can bill you directly. So that is the easiest way to do it. If you can achieve that, there is no transfer pricing, because your supplier is dealing with two different tax registrant. If that is not possible, then what you can do, you can add 5%. I'm just giving a number, and then it is an expense in.
Okay. Thank you very much. I would like to take this opportunity to thank all the panelists over here. And let's have a big round of applause for our panelists. Thank you.
discussion. Let us now move to the next presentation on the basics of taxation as we unravel the fundamental principles and concepts of taxation. We will equip attendees with a solid foundation and an understanding that will enable them to navigate the details of corporate tax laws, compliance, and planning with confidence and competence. I'd like to invite onto the stage Mr. Shiraz Khan, partner and head of tax, Al Tamimi and Company. Let's all please welcome him with a very big round of applause onto the stage, please.
Good morning, everyone. So I guess the corporate tax landscape in the region, and in particular in the UAE, has completely changed. We've gone from almost no taxes or limited taxes to a full tax system in the UAE, which was perhaps inconceivable around 10 years ago, or even 6 years ago, before VAT was introduced. So I guess the focus of today's session is I'm just going to touch on the basis of taxation, in particular who's taxable, who's exempt, how are you going to be taxed, before I focus on some of the impacts on businesses and what you guys should not be doing, and also what you should perhaps be doing in order to prepare. I know you're having a number of other sessions and panel discussions which covers other topics. So the focus is really to give you the basics on how taxation will work in the UAE, and then focus on what you guys should be doing to get ready. And then if you get time at the end, there'll be a Q&A session. Otherwise, I'll be available after the session to take questions. So just to begin with, and just to remind ourselves, what corporate tax is. Corporate tax is a form of direct tax. VAT and excise tax, which were introduced in 2017 and 2018, are forms of indirect taxation. So what's the difference? Direct tax, as the word suggests, is imposed directly on the individual, on the income generated by the individual, and that's what happens in the case of corporate tax. On the other hand, you have value-added tax and excise tax. These are indirect taxes. So they're not imposed on a person, they're imposed on a transaction. So both excise tax and value-added tax consumption. So VAT applies on the supply of goods and services, and excise tax on the consumption of selective products or goods which are considered harmful for human consumption. So this is the difference. In both cases, ultimately, someone bears the tax. In the case of indirect tax, it's passed on to the ultimate consumer. However, in the case of direct tax, it's borne directly by the business. So it is a cost to you. So when does corporate tax apply? Of course, everyone knows it's already applicable from the 1st of June this year, depending on the company's financial year. But corporate tax legislation already actually came into effect all the way back in December and January. Once the legislation was published in the official gazette, within 15 days it became effective. And the consequence of that is that even before corporate tax is applicable to you, you have to look at the impact, because it may be that you're going to engage in some tax planning, you're going to enter into some artificial structures or arrangements to obtain a tax advantage and avoid tax. So there are certain transitional provisions, and there's also general anti-avoidance provision. This is already applicable to you, even though you're not registered for corporate tax and corporate tax is not applicable to you. So otherwise, corporate tax will apply to you depending on your financial year. So if you have a financial year which starts on the 1st of June this year, corporate tax will apply to you this year. On the other hand, if you have a financial year which has already started before the 1st of June, it will not apply to you this year. it will apply to you for next year. So for example, if you have a calendar year, financial year, the relevant year, the first year which is subject to corporate tax will be the calendar year 2024. And then your filings will happen in 2025. Now in terms of corporate tax, who does it apply to and who is exempt? So I think the first thing to understand is that it's referred to as corporate tax, but it's not actually a corporate tax. It's a income tax on businesses. It applies to corporates and also non-corporates. I know there's a general misunderstanding that if you're an individual, you should not be subject to corporate tax because this is a corporate tax, but this is not correct. So even if you're an individual and you're carrying on a business, you will be subject to corporate tax. Now, when you consider to be carrying on a business, if you have a license, under which you're carrying on an activity, or even if you don't have a license and you're required to have a license, then in that case, you'll be considered to be undertaking a business. And there are still other circumstances where you don't have a license, you may still be considered to be carrying on a business. So you need to carefully look at, whether you're, as an individual, you're carrying on a business or not. On the other hand, if you're an individual who's not carrying on a business and who's generating income in a personal capacity, and it may be that you're employed and you're receiving some employment income, this is a contract of service. It's not a contract for services, which you would have in the case where you're an independent contractor. So in the case of an employment contract, your salary, bonuses, allowances, and any other employment income you receive in the course of your employment, in your capacity as an employee, will not be taxable. And similarly, if you're making some investments, so it may be that you invest in real estate, you receive rental income, or you sell the real estate and you generate capital gains, you make deposits in bank accounts and you receive interest income, or otherwise you buy and sell shares. So all of this will be considered as personal income, which will not be taxable. So who is taxable? If you're a legal person, you'll be taxable. So if you're a limited liability company, you'll be considered as taxable. If you have a foundation, foundations are typically entities which are set up for a specific purpose. The purpose may be educational, scientific, or whatever other reason. It could be charitable. If you have a foundation, in some jurisdictions like the DIFC and the ADGM, a foundation has limited liability. So therefore, it's treated as a taxable person. However, there is an election that you could make as a foundation where you elect to be treated as an unincorporated partnership, in which case the foundation is not the taxable person, and you look through who the founder is, who the beneficiaries are, in order to determine the tax status. And it depends on whether they're carrying on a business or not, they'll be taxable. If they're investing or they're doing things in a personal capacity, then there should be no taxation. For unincorporated partnerships, as I said, in the same way as a foundation, unincorporated partnership is not a legal person, so you have two people in partnership with a view to obtaining a common profit. And the individuals will be taxable depending on whether they're carrying on a business, so that an unincorporated partnership will not be treated as a taxable person. Otherwise, if you have a company which is incorporated in the UAE, if you have a foreign company which is not incorporated in the UAE but is considered to be resident, and I'll come on to that in a short while, or otherwise, if you have a foreign company which is doing business in the UAE, all of this will be taxable in the UAE. Now, there are some exemptions at the person level. So in some cases, if you're a government, your public body, your government institution, in that case, you will be exempt from corporate tax. And this is fairly common across the world. Of course, if you have a government is not in business. They're there to carry on a statutory function in a sovereign capacity, and the purpose is not to generate profits for stakeholders. They generate money, if they do, for the country to benefit from. In other cases, if you have entities which are wholly owned and controlled by governments, they will also be exempt. And then also charities and public benefit organizations, they will also be exempt, as well as pension funds, and investment funds. In terms of oil and gas companies, which are taxed under Emirates-level taxation, they will not be subject to corporate tax because under the UAE constitution, the right to tax oil and gas companies belongs to the individual Emirates, and in recognition of that, there's an exemption which is available for oil and gas companies, only if they're subject to Emirates-level taxation and to the extent of that. This exemption will not apply to banks. So if you're a bank, you're currently also, if you're a branch of a foreign bank, you're currently subject to Emirates-level taxation. However, under the UAE constitution, the right does not belong to the emirate. Therefore, if you're a bank, you will be subject to federal corporate tax. As of now, there's no news on whether there'll be any credit available. So potentially, the bank will be fully subject to tax under federal corporate tax and continue to be taxable under the Emirates level law. And, depending on, there may be a credit available under Emirates level. It's not clear at this stage. I think it's important to note that not all of these exemptions are automatic. So some of them, are automatic, like if you're directly a government or public body. Other exemptions require you to meet certain conditions in cabinet decisions. You need to be, in some cases, listed on a cabinet decision or meet the criteria in a cabinet decision. In other cases, you need to make an application to the Federal Tax Authority. So again, the point is it's not automatic. You may need to undertake some actions in order to avail of the exemption. Now moving on to the basis of taxation. Now there's two typical bases, how countries tax companies globally. There's residence-based taxation and there's source-based taxation. So generally, if you're considered resident in the country, under a resident-based taxation system, you're taxed on worldwide income. Whereas in the case of a source taxation, you're only taxable on some income generated from the country. Of course, any country which is introducing tax needs to have some sort of territorial link with the country. The company needs to have some territorial link. So whether it has a base through management and ownership, or otherwise through the operations and people, or otherwise, for example, if you're generating income from the country and the income is sourced from that country, this is how countries tax. Now, the UAE will adopt a residence-based taxation, which is in line with many international tax systems. And this will mean if you're a company and you're considered resident in the UAE, you'll be taxable on worldwide income. If you look across the region, generally speaking, all the taxation systems are source-based, except Oman, which has a residence taxation. And the main reason why the UAE has gone for residence-based taxation is probably because of the BEPS proposal, which I'm not sure you're familiar with. But if the UAE did not tax companies on a residence basis on worldwide income, then potentially those companies may be taxed in other countries. And that's why the UAE has gone for a worldwide taxation for resident companies. So again, going back to the point, if you're a company which is resident in the UAE, you're taxable on a worldwide basis. Under what circumstances are you resident in the UAE? If you're incorporated in the UAE, you'll be considered as resident here. And if you're a foreign company which is incorporated elsewhere, you're not incorporated here, but your effective management and control is in the UAE, in that situation also, you'll be considered as resident in the UAE and taxable in the on worldwide income. So if you're a company in the Cayman Islands or even the UK, and you're effectively managing control from the UAE, you'll be taxable in the UAE on worldwide income. What is effective management and control? This is actually quite an old concept which has been tested in other jurisdictions, and it's been incorporated into the UAE corporate tax law and also the guidance. So in the UK, there was a case called Dabiz, which established cases where a foreign company could be considered centrally managed and controlled in the UK. It's a similar concept. So effective management and control for purposes of residency is the highest level of control. So in terms of where the strategic decisions for the companies are made at the highest level. So it's the place where the board of directors meet and make decisions of the company. And if you have an owner of a business, where the owner sits. So you just have to look at each case on its own, and each case may be different. You have to look at who the owners are and where the decisions are taking place. at the strategic level, not at the operational level. And it may be that you're considered as resident in one country because you're incorporated in one country and you're effectively managed in another country, in which case you're resident in both countries. In this case, you would look at double tax treaties, which usually have a tiebreaker clause to determine residency. And they also use an effective management and control test. But this test is different to the one in the UAE, and this looks at the operational level of decision-making and management. So anyway, going back to the point, so if you're a resident in the UAE, you're taxed on a worldwide basis, and in the case of an individual, you'd be considered as taxable on all the income you generate from wherever for your business in the UAE. So if you have another business in Bahrain and you generate income for the business in Bahrain, you'll not be taxable in the UAE. On the other hand, if you have a services business in the UAE and you generate income from the US, from Sweden, you'll be taxable in the UAE because the income is generated from the UAE business. The effort which is put in, the resources which are employed are at the UAE level. Now, in terms of the taxation of non-residents, I've already looked at residents. Non-residents will essentially be taxable, in three situations. If they consider to have a permanent establishment in the UAE, in the case where they don't have a permanent establishment in the UAE, but they have some kind of nexus in the UAE, and I'll come on to that in a short while. And the third scenario is if they generate UAE-sourced income. So UAE-sourced income is very widely defined, and it's actually very wide. It's one of the most widest definitions of source I've seen, and it covers any payments made by a UAE resident or any income you generate from assets or capital employed in the UAE, as well as rights and benefits which you achieve from the UAE. So it's very, very wide definition. In all these three cases, you'll be taxable. In terms of income sourced in the UAE, this is typically subject to withholding tax because non-residents are typically required to only file a tax return if they have a presence. So normally, if you generate source income from the country, it's subjected to withholding tax. Withholding tax initially in the UAE will be at the rate of 0%. So the expectation is that if you have income generated from the UAE, and because there's initially no withholding tax, it shouldn't be subject to tax, but it's a little bit unclear at this stage. So some clarification is required on this point. Now moving on to what a permanent establishment is. So if you're a non-resident and you're doing business in the UAE through a permanent establishment, you'll be taxable on the income which is attributable to that permanent establishment. Permanent establishment is a fixed place of business through which you carry on your business. So certain things are deemed to be a permanent establishment. So for example, if you have a branch, factory, office, place of management, you'll have a permanent establishment in the UAE. On the other hand, if you have employees who regularly visit the UAE for continuous basis, that could also be considered as a permanent establishment. There are certain exclusions. So for example, if you're operating in the UAE, but you're not doing business, you're doing some activities which are preparatory and auxiliary, which are early activities. They don't involve you carrying on a business. So things like marketing, product development, and customer liaison, all of this stuff will usually be excluded under this exclusion. Now, even in the absence of a fixed place of business, you could still have a permanent establishment if you operate in the UAE through a dependent agent. A dependent agent is someone who habitually exercises the authority to conclude and negotiate contracts on behalf of someone else in the UAE. So you need to be careful if you have an agent, what kind of authority they have, and does this constitute a permanent establishment because they're a dependent agent. Of course, this isn't intended to affect independent agents. So an independent agent is someone who would, in the ordinary course of their business, be your agent, and the activities they perform are in the ordinary course of the business. But if they're exclusively acting for the non-resident, or almost exclusively, then they will not be considered as an independent agent. The third thing is that if you're a non-resident and you have a nexus in the UAE, you'll also be considered to have a permanent establishment, which means you have to register and file a tax return. Previously, it was unclear, but based on some decisions that were issued, if you're a non-resident and you generate income from the UAE from immovable property, whether it's a rental income, or licensing income, or otherwise, from the sale of that property, that will be considered as having a nexus in the UAE, so you'll be taxable, and you're required to file a tax return. Now, in terms of the rates, there are two rates in the law: a 0% rate, which is applicable to income up to 375,000, and this is designed to give small businesses or startup businesses relief. Any income above this threshold will be subject to tax at the standard rate of 9%. There is a third rate which has not been incorporated into the law, and this third rate is expected to be 15%, which will apply to multinational groups, groups which operate in 2 or more countries and have a consolidated annual revenue of 750 million euros. In this case, they'll be subject to a different rate. And again, this is not set out in the law, but some other legislation is expected to be issued to deal with this. Of course, if you're a free zone company and you meet the criteria of the exemption of the free zone, then you could also benefit from 0%. And I think there's going to be a panel discussion later on dealing with this. In addition to the 0% rate, there's also small business relief. So if you're a business and you have annual revenue of more than 3 million in the current year and the previous year, then you should be able to benefit from this relief, and you shouldn't be taxable up until the end of 2026. It's not clear whether this relief will be applicable in the first year, but I think the expectation is that it will. It's just in terms of the 3 million criteria, it's defined as the current taxable year and the previous taxable year. But of course, the previous taxable year is not a taxable year if corporate tax didn't apply to you. In terms of the administration, of course, you need to think about registration. So there's no deadline as such for registration. You could register any time before you file your first corporate tax return and you pay the tax. You do need to prepare financial statements, and these financial statements need to be prepared in accordance with IFRS. In certain cases, if you're in the free zone and you're benefiting from 0%, you will need to undertake an audit. And if you have, I think it was revenue of over 50 million, you also need to undertake an audit. Otherwise, audit is not required from a tax perspective, and whether or not you have an audit will depend on your regulatory requirements. The corporate tax return, as with other jurisdictions, will be prepared on a self-assessment basis. So you will prepare your return, submit it online, and the tax authority will then audit the return, and if they disagree, issue an assessment, which you could challenge. The corporate tax return will be due 9 months from the end of your financial year, and the payment will also be made on the same day. The system is going to be quite simple, so no provisional tax returns as you have in other jurisdictions, and no advance payments or installment payments, for corporate tax. So a single payment. And this is designed, if they disagree, issue an assessment, which you could challenge. The corporate tax return will be due 9 months from the end of your financial year. 9 months gives you ample time, and the payment will also be made on the same day. You also need to maintain documents as well, provisional tax period as you have in other jurisdictions, to the period and no advance payments, something installment payments, for corporate tax. So a single payment. If there's any areas of uncertainty, you can obtain a clarification from the tax authority on their interpretation of the law will be due 9 months from the end of clarification. 9 months gives you and the payment will also be made themselves administrative. Your system is going to use documents against some provisional tax period input from other jurisdictions. If there is areas of uncertainty, no advance payments, something installment payments, for corporate tax. Now, just to touch on this uncertainty, you can obtain a clarification which you could challenge on their interpretation. I think the first thing you learn from this clarification 9 months and the payment will also be made administrative. Your system is going to use mistakes that were made original tax period. Of course, corporate tax, if there is areas of the first no advance, it's going to be a cost to your business. In the financials, this uncertainty one of the most important figures which you can CFO I think the first, in addition to that, there's the clarification 9 months and the payment will also be made administrative. Your system is going to use mistakes that were made original tax period. Of course, corporate tax, if there is areas of the first no advance, it's not to be a cost to your business. In the financials, this one important figure which you can they were doing something wrong. They were complying with the rules, but they were seen to be and perceived to be not paying their fair share of taxation. So it's very important to make sure that you pay your fair share, and that's why you need to comply. There's also additional penalties, 3 times the amount of tax for tax evasion. And tax evasion obviously involves dishonesty, so you're concealing information, providing false information, forging documents, and there's also imprisonment. And it's important to note that these offenses, they're not applicable just to employees at the company. They could extend to anyone, including advisors or anyone else connected with the company who's involved in the evasion. So there's some secondary liability there, which is very, very serious, and so you have to take this very, very seriously. Now, going back to the point, corporate tax is being introduced for the first time. It's going to be new, as with VAT, except it's 100 times the complexity. So you really have to look at the impact of corporate tax on your business, understand how the rules work, how they apply to you, in order to avoid a situation where you're subjected to penalties and it has a negative impact on your business. I think what we saw in the introduction of historical taxes like VAT was that there was a lot of delay on the side of the authorities in terms of guidance and in terms of issuance of legislation. And of course, now the corporate tax law has been introduced. A lot of documentation has also, a lot of other legislation has also been issued. There's still a lot of legislation yet to be issued. And the mistake a lot of businesses made, that they waited for, until VAT was applicable, until the 1st of January to do anything. So you need to start now. The other thing was that in terms of the tax authority, they also knew corporate tax is new for them as well. It's going to take them some time. And you need to think about training within your organization as well to manage the expectation with senior stakeholders and other stakeholders across the organization in order to minimize the disruption. Now, just to sum up, because I'm conscious we're running out of time, I think it's important for you to have a project plan. The introduction of corporate tax won't affect just the tax department. It's relevant to the entire organization. So you need to think about the impact on all functions across the board, from finance, legal, technology, and you need to gather people from different areas and functions so you could talk to each other and determine the full extent of what the organization is doing to assess the impact. Because it may be that you've been at an organization for 10 years, but you don't know how it's operating. You don't know which territories it's operating in. There's new decisions made all the time, and you're not aware. And you could only bridge that gap by connecting with people across the organization. The second thing you need to think about is whether you should have a tax function or not. And there's 3 common models: having an independent tax function, having a tax function under finance, and having a tax function under legal. So you need to think about this model, and so whether you have a tax function or not, whether you outsource, what you're going to outsource. If you're going to have a tax function, you need to have a tax policy, tax strategy, and risk management framework with an approval matrix in terms of if something goes beyond a certain level of risk, then you will defer to independent consultants who will give you a view. And this is your defense internally before your management and before the tax authority in the future. The other thing you need to think about is an impact assessment. So of course, corporate tax coming in for the first time will impact your entire business. So you need to review your legal structure, your operating model. You need to consider the impact corporate tax has on you. And you also need to think about areas where you need to make some changes. It may be that you're involved in some practices which you no longer will be able to engage in after the introduction of corporate tax, and it'll put you in a penalty situation. So you need to review what you're doing, and you need to look at what you can change in order to be compliant and in order to be tax efficient. Your IT functions need to think about the capability of the IT system in order to do the reporting for corporate tax. The legal function needs to think about the contracts and withholding tax clauses and other clauses to protect yourselves. The finance function needs to think about processes. In order for expenses to be deductible, you need to have documentation. And in the future, when the withholding tax rate increases, you need to have processes in place to ensure that withholding tax is applied by your payables function. So again, it has an impact across the entire organization, and you need to think about all of these things in order to be ready. Transfer pricing is also very important and historically hasn't been thought about. So if you have related party transactions, you need to think about pricing those transactions on arm's length terms, and there will be penalties in the event that you don't. And in certain cases, you may be required to maintain documents. Even if you're not required to maintain documents, you may consider maintaining them in order to defend your position. And you also, before you register, you may need to make some elections, and you may need to apply for exemption, for example, and some certain incentives. You need to think about this before. I think the bottom line is that the failing to prepare is preparing to fail. So you really need to think about all of these things even before corporate tax is applicable to you. And the burden and onus is on you to get ready and to comply. If there's any questions, I think we're over time now, so yeah, I'll be happy to take any questions after the session as well. I'll be around. Thank you. Thank you. Thank you.
Thank you so much to Shiraz for bringing onto the stage a deep understanding of the legal and regulatory environment of the UAE. The CTA tax has already been launched and several more decisions for implementations are expected soon. Let us now call onto the stage our next presenter to speak on how to get business prepped and ready for corporate tax. Let's please welcome Pratik Toshwil, partner MIC Technology. Let's all give him a big round of applause and welcome him to the stage, please.
Morning, everyone. I know the last slide that we had was about the next business steps that we all need to keep. But my voice is as clear as the corporate tax is understood in this region right now. And I feel that we all are there and we have done our impact assessment. And if not, we need to start today, because that's the first step anyone needs to do to understand where they stand in the corporate tax in the region. And as my colleague said, it is very important to do that impact assessment for 4 primary reasons. One, to understand which are the entities liable to corporate tax, whether the tax grouping is beneficial or not beneficial, whether the tax that will be applicable to the entities will have all the deductions and exemptions, and fourth, whether you will get the carry forward of losses and how much you will be getting it. So I'll get this room a little into a Q&A mode. A free zone entity having 45 million dirhams as the turnover, is the audit mandatory for that free zone entity? Yes? Anyone in the room who feels no? Because the threshold limit, yes, you feel it is no. Why? 50 million. So that's only applicable apart from free zone entities. Every free zone entity has to get the books of accounts audited. So that's where the complexities lies. But to challenge that on the other side, any free zone entity having an annual turnover of 2 million dirhams, should it opt for a corporate tax because they have a small business relief of 3 million? What do you feel? Depends on the growth. That's one. Because the election changes after 5 years. So any free zone entity having 2 million dirhams as their turnover is a question whether to opt for a corporate tax or not to opt. So these are the complexities that these corporate tax will have when you judge your own books. So the first will be the impact assessment. And before I go to the presentation, this is all personal views as a firm that we have taken. And we believe that FTA still will have all the majority. So as Albert Einstein said, I don't know if it is true or not, but the hardest thing to understand is corporate tax. And I feel the complexities is very important if done right. We may have different opinions, but if done right, it is not that as hard because we just have 20 chapters and 70 articles. And UAE has over 700,000 businesses registered, to which I believe 30 to 35% will be under the purview of corporate taxes. But we all should be prepared that at the end of 2024, we will have 91% of our income with us and 9% with the government. We all should be ready with that assessment. Whether we can optimize it, whether not, is something that your impact assessment will do. I'll just take you to the highlights. I'm sure, it is all of this has been covered. But what is very important in the impact assessment is the tax group and the carry forward of losses. But second thing that is very, very important is valuing your assets up to the latest date, because otherwise the capital gain impact might hamper you. So it is very, very important to value or revalue your assets that is standing in the books of accounts so that you can save your capital gain taxes later on. What do you need to get ready for UAE corporate tax? You need to do the robust internal controls as a system or as an entity. What you should do is and prepare your books of account according to that. Because once you've done it, you will know what has to be done, what not has to be done, and all the provisions around it should be implemented. Maybe within the firm, or you may take an expert opinion. But this is very, very important that you do the robust implementation at the cutoff date, and everyone should be prepared that 31st May should be your, or 2023 should be your cutoff date to make that implementation so that you're ready for the corporate taxes. What do you also need to do? Because after 31st May, there were a lot of changes that was, updated. Still the FAQs on free zone is pending, but I believe that we need to keep staying updated with the new tax updates which are coming, and we need to always keep ourselves updated so that even after our impact assessment and the robust implementation, we can change what is there that has been updated by the FTA. What remains very much important is to maintain accurate financial records. Now, there are a lot of deductions which is allowed, a lot of exemptions which are allowed, but how much is allowed, how much not is allowed is important. So, directly attributable to business expenditure, it is fully allowed. But say entertainment expenses, it is 50% allowed. Interest expenses, it is 30% allowed. So you need to make sure what is allowed and what is not allowed in terms of your business. So I have just one question here. If you go with your team to a business dinner and you have just one client in that dinner, but your entire team is present, whether that is entertainment or whether it is a business expenditure, is something that you'll need to define as the entity, because it has two aspects. Entertainment can be a dinner as well as a movie or out of town halls. But entertainment with business can also be a business expenditure directly attributable. So it is very, very important to understand what is deductible, what is not deductible, and how much can you take the exemptions of all the other things. Even dividend, for that matter, will be very, very critical. Moving on, we also need to understand the UAE corporate tax system as on date, whatever has been implemented has to be implemented within our entities to make sure that we as an entity are ready from day one instead of 1st January 2024, because lot of exemptions or lot of deductions, if not ready today, probably may create a hassle when we are later on in the system. Obviously, we need to determine the taxable income. And as I said, a lot of us, the MNCs and the mid-sized corporates, will already get their books accounts audited. So with that, if we can determine the taxable income, it saves 6 to 8 months of our time, and we can with our tax consultant discuss how to make it better or probably optimize it for the next year where it will be actually applicable. Understand the incentives and the exemptions. As I discussed, dividends, whether it is exempt or not is something that we need to take care of. Whether the participation exemption comes into picture, all of that needs to be understood. I say that consider engaging tax professional is important because all of us as professionals will need help or support. However, it is all based on the opinion that that firm takes, and we may have different views when the engagement is done, because it is a still complex structure where we are still learning and evolving every day. And that is why it is very, very important to have one opinion as an entity or one opinion which is being followed. And I'm sure a lot of the MNCs and the mid-sized corporates are already into the they are making the transfer pricing documents as well for their entities abroad, as well as the corporate tax is being managed. But what is also important is whether we should do tax groupings, because if you do tax groupings, yes, it reduces the compliances and transfer pricing is not applicable, but it also reduces substantially the amount of the exemption that you have, 375,000 dirhams, into 100 entities, which gives you 37.5 million, or just 375. So that is a cautious call that an entity will have to take while preparing this. And this is the team that we have. Any questions, I'm more than happy to answer it. Thank you so much, guys. Thank you so much for understanding of the basics of it.
Thank you so much for the wonderful presentation. As we explore the global dimensions of taxation, we will unravel the profound impact it has on multinational organizations and cover the potential opportunities and strategies that can be harnessed in the ever-expanding marketplace of the UAE. For this very interesting topic, I'd like to invite here onto the stage Mr. Pratim Sangputta, Associate Director, Direct Tax, Anderson, UAE. Let's all please welcome him to the stage with a big round of applause.
Good morning, everyone. Can I hear a good morning from everyone? Good morning. So my topic, as you can see, is international tax. Before I begin, can someone tell me what's the difference between international tax and corporate tax? Anyone? No? So international tax is another form of corporate tax, but only kicks in when you have international transactions. So if you are, say, a UAE company, right, and you are operating only within the four corners of UAE, your UAE corporate tax would ideally apply, unless you carry out certain activities where international law will also apply. I'll get to that in some time. But as soon as you have transactions, cross-border transactions, say to another country, or you're a multinational, where if you're a subsidiary or you have subsidiaries abroad, international tax law applies. And what is this? So these are usually tax treaties. So whenever you make a cross-border payment, suddenly what happens is that payment would be subject to tax from the other country. How do tax treaties work? You need to see so these are bilateral documents. So say, for example, you have an entity in another country, say UK, and the UK entity is paying you dividends. A tax treaty will basically tell whether the dividend would be taxable in the UK or would be taxable in the UAE, and at what rate it might be taxable in the other country. So it's just assignment of taxing rights. So today, the UK or the UAE tax treaty could also say that this dividend income is not taxable in UK at all. It's only taxable in UAE. So this is why whenever you have some sort of a cross-border payment, along with your UAE corporate tax, you will now have to refer to a tax treaty as well. So, globally, this has seen a vast change over the last 6-7 years, international tax. Why? Because as companies started globalizing, right, as they started to have footprint across the world, say in the 60s, 70s, what happened was there were opportunities of tax efficiencies. What do I mean by that? Suddenly you had a country where maybe the headquarter was placed, say in the US, where the tax rates are, earlier they were 30, now they are close to 20, and they may have a subsidiary in a country where the tax rate is 0%. Suddenly this gave rise to profit shifting. One would say, just pass on a loan or pass on some services, and suddenly you had opportunities of reducing your global ETR from not 30, but you had the opportunity of reducing it to minimal, even 0%, 1% in certain cases. So to tackle that, right, all countries got together, OECD countries, OECD is an international organization, got together around 2015, along with some other member countries, and they started tackling these issues. These are called BEPS action plans, which are base erosion and profit shifting measures. So the world has seen a huge change in landscape over the last 7 to 8 years, where all these opportunities for tax efficiencies are reducing. They're trying to tackle it, and that is why you would have heard this word called Pillar 2. Pillar 2 comes out of these measures. I will cover this. It's basically like a global minimum tax of 15%. But while saying so, I'm just not scaring you. There are certain, because of UAE corporate tax coming in, there are some avenues where UAE could benefit from having a corporate tax regime. The basic, everyone's thinking, my God, corporate tax is coming in, it's going to kill our margins, everything, but it might just invite, in terms of, investments or foreign investments, because when we compare UAE as a jurisdiction to other countries now, with corporate tax coming in, there are places where dividend or capital gains or royalties may not be taxed. So just as a holding company jurisdiction, UAE seems to be quite an attractive destination now. Especially, now we've shared these factors, right? It's well connected, it has good banking facilities, foreign ownership is now there in this, in this region. So from a regulatory perspective, it has all the setup, all the infrastructure. Now, if there is any foreign investment, they can have a holding company in UAE. I'll get to this, how this might be efficient later. And they could have subsidiaries going forward. It could be a UAE subsidiary, or it could be a foreign subsidiary as well. And when I mentioned tax efficiencies, right, or tax benefits, corporate tax in UAE is just 9%. When I compare that to other jurisdictions, it is one of the lowest in the world, if not the lowest, along with another country. So, while reality, and I went back to the fact that, 7, 8 years back, countries started working towards, a solution where there are no tax havens at all. Corporate tax has become a reality. So coming up with a 15% global minimum tax and then comparing UAE, 9% it's quite favorable. That 15% may not apply to all companies or all groups. I'll get to where it would apply later on. Now, UAE also has a vast treaty network. So wherever, around I think 130 plus, so wherever the cross-border payments, you have the opportunity of looking at the treaty and seeing the tax on reducing a taxable base there. How does this work? Why are tax treaties so important, right? You may ask, say if you don't have a tax treaty, say if UK or UAE never had a tax treaty and the dividend was payable from UK into UAE, UK can withhold taxes on that dividend as per their domestic tax law. That could be 20 to 25%. But with a treaty, usually that withholding is restricted to 10%. So it's always advantageous of having transactions with a country that you have a tax treaty with, where you can get the benefit of a reduced rate taxation. Now moving on, there's a very interesting slide. So like I mentioned, even with the arrival of UAE corporate tax, it's still quite a favorable destination. Now, if I compare it with other holding company jurisdictions, which are very popular in the world, say Singapore, Mauritius, Netherlands, or Ireland, you can see how the rates are so much more favorable compared to the other holding company jurisdictions. UAE has a far more competitive corporate tax rate of 9%. And in terms of withholding taxes, UAE has kept the rate at 0%. So if there's any cross-border payment currently, now going from UAE to outside UAE, it's all at 0%. When you compare that with other holding company jurisdiction, there is a rate that will be applied. And when I now see capital gains, when you sell the shares of a subsidiary, say abroad, or when your foreign parent sells shares of another company in UAE, you can potentially get 0% on that gain as well if you meet participation exemptions. So throughout this, if for cross-border payment or cross-border transactions, it is a very, very favorable jurisdiction going forward. Now let me explain this through okay, before this, I'll get to this slide later. Let's get to the example. Say an investor has 100% shareholding in a holdco. The holdco has a free zone entity, has a mainland entity in UAE, has an India company subsidiary, has a Singapore company as a subsidiary. And India company pays and the Singapore company pays dividend, capital gain, say there's a royalty transactions as well, and so does the UAE entity pay. How would this be taxed? Now suddenly, when it's dividend, right? UAE companies paying dividend to holdco is absolutely at 0%. So UAE company to UAE company is 0%. From India co, foreign co to UAE company would also be exempt if you meet participation exemption conditions. And these are not very, very difficult to meet because it just requires you to have a minimum 5% shareholding, which is consistent with the lowest rates available in the world for participation exemption. So if you just have a 5% or more shareholding, suddenly any dividend that is coming to the holding company from outside UAE is 0%. Same thing for capital gains. What if you sell the shares in the future? You have to again meet participation exemption conditions, which are not very difficult when you set up holding company entities within UAE. So if you can see, your dividend capital gains are exempt and the conditions to meet are quite easy. If it's royalty, the difficulty comes now is royalty. Everyone thought you could have IP companies in UAE and maybe you can get free zone benefits from there. What the next panel will touch upon it, this may be taxable at 9%. Now when it comes to withholding, I've already covered. There is no withholding tax, domestic withholding tax right now in UAE, only on cross-border payments. So if anything that India company or Singapore company, pays to the UAE entity, India and Singapore will apply withholding tax, okay? But if these incomes, say you are paying royalty, right? Say royalty is taxable in UAE. If you're paying tax in UAE on that royalty income, and whatever India has withheld on that income, you can claim as a foreign tax credit. But it cannot be more than 9%. So somewhere your cost will be equivalent to the rate. But if you did not tomorrow have a treaty with India, India would withhold probably a much higher rate than this 10%. So this is where treaties come into play. That's why the advantage. You might say, I'm anyway paying 10% corporate tax, but this is certainly lower than what the world has to now get used to, is a 15% minimum corporate tax for large multinationals. And this is a very, very competitive rate, and corporate tax has become a reality across the world. Now, what if this holding company was a free zone entity? I don't want to encroach upon the next panel's topic, but if this holding company was a free zone entity, you could potentially even get a 0% on, not the royalty may not be covered, but on other incomes, right? So you'll have to see. So there may be benefits of having this holdco in a free zone as well, because that is how the free zone law has been drafted. The next panel will cover how this free zone and what are the benefits of a free zone entity. Quickly, moving on to Pillar 2. Everyone has heard this word. Has everyone heard Pillar 2 in the market? Yeah? So what is this Pillar 2? Like I mentioned, it's a global minimum tax, 15%. But a lot of people, forget this, these are very technical jargons, right? So a lot of people may not be aware how it might apply practically. So usually it applies to groups that have a group total consolidated revenue of 750 million euros or more. Okay, so if you are a UAE-based group, if you have a revenue of more than 750 million euros, this rule may apply. But it doesn't apply to you now because UAE has not legislated these rules yet. A lot of European countries have now legislated, it is anticipated. This will be a different legislation when compared to corporate tax law. It is a kind of a corporate tax itself, but it will not be part of the corporate tax law. It's a whole new set of rules and regulations where the starting point and even the adjustments that you make to your income are different. And basically, these rules are called globe rules. And these will be different. And it is anticipated that UAE may bring these rules in, say, end of this year. By end of this year, maybe effective from, let's see, if it's end of this year, they may make it effective from only 2025 onwards. So if you're a large multinational with revenues of more than 750 million euros, that is same threshold as, say, a CBCR filing that you may already take care of, then these rules will apply to you. And if you are a subsidiary of a large multinational, then also it might apply to you. So it's not only for UAE headquartered multinationals, it also applies to a subsidiary that is part of a larger multinational group which is based outside UAE. Just as an example, globe rules work in a very top-down manner. What do I mean by top-down? Say, if the subsidiary was in a low tax jurisdiction, for example, BVI, right? And UAE legislates Pillar 2. So if the holding company, so you have to see where the ultimate parent is located. The first taxing rights is there with the ultimate, where the ultimate parent is located. So if the ultimate parent is located in UAE and the subsidiary is in BVI where the tax is 0, UAE will have the right to collect that 15% tax. So why, and then you will be asking, okay, so if I am a subsidiary company in UAE, and right now it's 9%, and I'm the subsidiary of UK, so who will collect the difference between 15 to 6%? Till UAE does not legislate Pillar 2 rules, it will be UK. UK will get the taxing rights, differential taxing rights. And then UAE would be losing out on tax revenues, right? Correct. That is why all countries are now legislating minimum tax, where UAE will also say any UAE-based company above this 750 million threshold has to pay a minimum tax of 15%. And that timing may be 2025 most likely, but we'll have to see. So for large multinational, it's not going to be 9% going forward, it's going to be 15%. 9% will be for anyone other than large multinationals that don't satisfy this threshold. I have an example how this top-down approach works. Say you have a company in a foreign jurisdiction, it's a high tax jurisdiction. It has 60% shareholding in B. And B company, you can see it's hyphen, it means Pope. Pope is nothing but a technical term in Pillar 2, which is called partially owned parent entity. It's an intermediate parent entity, but it's partially owned by A company. B company holds 100% of C company. Again, all three, A company, B co, C co, are all in high tax jurisdiction. They have implemented Pillar 2. Suddenly you have D company down the chain, way down the chain. It's in a low tax jurisdiction and it has not implemented Pillar 2 rules yet. It pays 0% tax. Where would the 15% be allocated? Who would get the taxing rights? The way the rules, when I said top-down approach, right? Ideally, in a normal structure, A would get the first taxing rights of getting 15% of, like A company would collect 15% of D company's profits in A company's jurisdiction. But this structure is unique. You have a partially owned entity right in the middle. The way the rules read, it's a bit complex. B company would have the first taxing rights in this structure. So this is just an illustration. So D company's profits would actually get taxed in B company, in B country. So as you can see, structures, applications of this rule can get very, very complex. And you have to see your structure and you have to anticipate this rule as well. So while you have your UAE corporate tax law, you have tax treaties, but Pillar 2 is soon going to be a reality as well. And you'll have to see how and where and which country would get these taxing rights going forward. First, what to look out for? Timelines. When will UAE legislate this? Second, do you even fall under these rules? Do you meet the threshold? You don't meet the threshold. Third, if you're a subsidiary of a foreign multinational, then it is likely that if you're a 9% company, corporate tax paying entity, somewhere the differential, who would have to pay the differential? Would it be UAE? UAE would collect this or UK would collect this. And the set of competition, the rules are completely different. So while your systems may be geared for UAE corporate tax, it may need a certain change when Pillar 2 comes in, because Pillar 2 data points are different to UAE corporate tax law data points. The computations are different. How you compute your taxable base is different. For outbound structures, if you're a UAE multinational, you have to see, and here UAE would get the taxing rights ideally. So this is all the more work where you have to identify which all countries you have subsidiaries in, whether they are high tax jurisdictions, whether they are low tax jurisdictions, and get prepared for Pillar 2. This is soon going to be a reality, and it will be there in a year or year and a half. So identify whether this applies to you or not. So with this, I conclude my presentation. Thank you all. Any questions?
Thank you so much for highlighting the impact and the opportunities and the fantastic presentation. Our next discussion is on the significance and importance of city tax on the free zones in the UAE. Some of the questions that most of you would have faced in the past is city tax valid in free zones? What are the qualifying activities excluded and included? Are there some specific zones? And to answer all these, let us now invite our honorable panelists onto the stage. I'd like to invite Manoj Maro, Director, Transaction Advisory and Group Reporting Expert. I'd like to also invite Nirev Shah, Director, Fame Advisory, and Tyne Hugo, Senior Associate, BSA, and our moderator, Anuraj Shitruvidi, Chief Executive Officer at Anderson UAE. Let's all please welcome our esteemed panelists on to the stage with a very big round of applause, please. And I request you also to keep all your questions ready for the panelists, and you'll get an opportunity at the end of the panel to ask any of the questions that you may have.
Hello. Just about to, the afternoon. So thank you so much for being here, everybody out here. So I'm sure, since morning you have now dodged up and with full of knowledge from the corporate tax perspective. So there's a lot much happening in this space. I'm sure, you all are keeping the updates on, what's happening. The Ministry of Finance is continuing to share a lot of knowledge on this space. They're clearing a lot of doubts which we're having.
To do that, you'll need to be online.
So when the doubts are getting cleared, but at the same time, all these informations are creating much more, the clarity, much more clarity that businesses are needing to adopt the new regulation that is coming out there in form of corporate tax in the UAE.
To do that, you'll need to be online.
It's all right. It's all right. Yeah. Sometimes, these tax creating, things are there. So essentially, if we all understand that in the UAE, we have two sort of, zones are there. So one is essentially the mainland, and one is basically other part, which is the free zones out there. So when the corporate tax introduced in the UAE, the first sort of information came out there. It was kind of, bringing out a thought that the free zones will be subject to exemptions, and whereas the entities within the mainland will gonna be paying the tax out there. So a lot of people were happy and they were thinking about that, look, let's move out to free zones. And it was the situation until the last cabinet decision that came out then 139 that talks about what is going to be in sort of exemption. So today I have the panelists who are very experienced, we are very savvy experienced and heavy duty, they are assessing a lot of clients, their organizations. So the first question that I wanted to understand to Neeraj Bhai, he's advising a lot of free zone clients and businesses out there. So Neeraj, help us understand what this Ministerial Decision 139 is all about. And there are specific terms around it which saying qualifying income, non-qualifying income, qualifying free zone, non-qualifying free zone. And the whole UAE is at the moment wanted to understand the trade that is happening between the UAE out there, how that is going to be taxed. So just for benefit of everybody, if you can just narrate, your experiences about this. Yeah.
Thanks a lot, Anurag. And thank you, College Times, for inviting us on this panel. So let me start with laying down the ground. Like you said, that it's very interesting that how we operate in UAE is quite unique as compared to many other countries, because in any country you will go and see maybe 1 or 2 free zones are there where you get certain benefit. And we have unfortunately 45 or 47 free zones, and it's not something very easy to kind of deal with, because it's quite unique in terms of what happens there. Now, if you step back, when the consultation paper was out, like you said correctly, first thing they said that, okay, we'll have conditions which are attached to free zone persons. They cannot do certain things. If they don't do those certain things, you'll get the benefit. And all the media kept on saying that, they'll get benefit. We are happy to support the promises that were given by the free zone that you'll continue to have the exemption and so on and so forth. When the law came out, they moved a little bit further. They said, you know what, we can't give blanket benefit to everybody. We need to define who will get benefit and who will not. So you'll have a qualifying income criteria. And then when the rules came out, which is Cabinet Decision 55 and 139, they said, no, we'll go one step even further, that you'll only have qualifying activities which will get the benefit and nothing beyond that. So of course, my 2 colleagues will go into those further detail, but let me first explain you that any company, so it's a corporate tax, any corporate which is registered with a free zone is a free zone person. Now, for a free zone person, directly there are no benefits unless you become a qualified free zone person. So when you come to the term qualifying free zone person, then the most important condition attached is having substance. And that's where, thankfully, the Cabinet Decision 55 and 139 Ministerial Decision has thrown a lot of light. So we were earlier starting to apply the ESR concept of substance. Now they have specified very clearly that 1, you need your core activities to be conducted from the free zone. You need adequate people. You need adequate office or equipment to support that entire facility. And unless you have all of this, you are not going to be a qualified free zone person even asking for any benefit. So this is the fundamental aspect that one needs to first look at. Forget looking at you're a free zone company, whether you'll get benefit or not. That's secondary. Your first condition that you need to satisfy is whether you are going to be a qualifying free zone person. And for that, now they've added 2 more conditions, that you should not have other income which is more than 5% and few other, and you have to have audit which is mandatory, right? So if you look at the 6 conditions together, only then you become qualifying.
But then one counter question to that, when we look into this substance, when we look into the ESR came out there, Economic Substance Regulation, it talks about, all these points that you mentioned about having a right employee, right assets, the income criteria is out there. Do you see essentially, from a free zone perspective, you deal with a lot of people. Do people actually understand that? how they are adopting to this need of ESR basically, and I mean, kind of substance. And because this is fundamental for you to adopt that exemption. I mean, where are you going to start? The starting point is this.
So that's why I'm saying that first thing is to meet the substance criteria. If you don't meet that, you can't even ask for the benefit even though you're otherwise eligible to get it, number one. In economic substance time, we started looking at what kind of operation they have, whether they are hosting board meetings here, do they actually have control and management out here or not. And all of those factors were then populated and given when the ESR audits came or even the ESR reports were filed. So similarly, under this now, we need to look at, now fundamentally, they are saying that core income generating activity of that free zone has to be conducted in the free zone. Now, this is going to significantly impact a lot of companies because here you have 50-60% companies which have very small operation out of the free zone, or you don't have sufficient operation, and then you want to claim all the benefit that the free zone wants to give you. So that's not going to happen. And that's where the word adequate is going to get a lot more significant going forward because it's in relation to your operations. And therefore, it is very subjective. You cannot define that accurately as a X, Y, Z criteria.
Absolutely. So my question to that, I mean, just to add to further on that, when we talk about the qualifying income kind of stuff, right? So Tan, my question to you, can you help us understand what all these different classes of incomes are? Basically, the qualifying income, non-qualifying income, what is it all about? So help us understand the everybody out here. Yeah.
Sure, absolutely. Firstly, I'd like to thank the Khaleej Times for having me up here. There's qualifying income, non-qualifying income, and there's disqualifying income. And they need to be differentiated. Basically, qualifying income would be any transactions between free zone persons or between any domestic or foreign income from the free zone persons and other entities outside the free zone if the free zone person carries on a qualifying activity, which my colleague has substantially commented on. So for you to have qualifying income, you need to have the qualifying activity, you need to carry it out, and I believe those will be elaborated on further later on. Then any non-qualifying income is income that is attributed to the excluded activities or that is not listed in the qualifying activities. Now, just because you may earn income from excluded activities doesn't necessarily disqualify you. You will be disqualified if you do not meet the de minimis requirements. Now, the de minimis requirements are in one tax period, either 5 million dirhams if your income exceeds 5 million dirhams, or 5% of your revenue, whichever is lower, then immediately you are disqualified from being a qualifying free zone person. And in such a case, you, for 5 years, will be treated as a normal onshore entity in terms of paying 9% tax on any income that's over 375,000. Even if you meet the qualifying free zone requirements for the next 4 years, it doesn't matter. You are banned from, well, not banned, disqualified for 5 years.
Which means it is quite a very important point to consider. So they are saying that the ministry's view is that the moment you come out of the qualification, that qualification is not available to you for next 4 more years, right? I mean, it is something very substantial. So because I think this is to foster, the kind of rules and kind of purpose for which the free zones have been established, I believe, right? So that's very important.
Absolutely, it is extremely important. And people need to educate themselves because a lot of companies, especially in free zones and how they're set up here, carry on numerous activities and they treat it as one entity. And those activities can disqualify them from being qualifying free zone entities. And now they've got the other side of the coin where if they specifically go and change their business structure, which has operated for 10 years, the FTA has the right to go and investigate this on tax avoidance principles.
Very nice. I mean, adding that point to that, I mean, you mentioned about different classes of assets, so being qualifying, activities, non-qualifying activities. I'll come to that further. But then let me understand, like, from Manoj. Manoj, based on your experience, I mean, you're working with, your organization out there. Help me understand about what are those excluded activities out there? I mean, is there any exclusions? What are those exclusions are there from an qualification perspective?
Thanks, Anurag. Thank you, College Times, for giving me an opportunity. First, I would like to tell you this is more of my personal view than my employer's view. So let me first explain you what are the qualifying activity and in line with excluded activity. So as per the Article 2 of Ministerial Decision 139, there are 13 business activity which are classified as qualifying activity. So if you see, which also includes ancillary activity, which is not an independent function but required for the performance of the main qualifying activity. So for example, there is one qualifying activity which is manufacturing of goods and material, okay? There is a company who is in free zone who into manufacturing of say industrial products, okay, who have a customer in free zone, who have customer in mainland company, who have also customer overseas customer in foreign countries. And apart from manufacturing of industrial equipments, they are also into say repair and maintenance or providing AMC services to their customers. So from my opinion, because they are into manufacturing of industrial equipments, which is a qualifying activity, so irrespective of the customer location, whether they are into free zone or non-free zone person, it will be 0% taxable. But here, if they are dealing with natural person, okay, where exclusion has not been given for manufacturing company, then it will be excluded activity. And it will be subject to de minimis rule, where you need to ensure that the quantum of transaction where you are dealing with individual has to be as minimum as possible. And then coming back to another activity, say you are into repair and maintenance of those manufactured equipments or into AMC contracts with the customer whom you have sold those goods. So that can be qualified as an ancillary activity, which from my opinion perspective, it's not an independent function, which is required more for the performance of the manufactured goods. And let's see one more example, which I really liked about as a qualifying activity, which is headquarter services to related party, which is very much relevant if you are in free zone, because there are so many headquarters or head office which are based in head office and work as a shared service cost center where they have centralized treasury, centralized HR, IT, procurement, and they provide lots of services to subsidiaries, joint venture, or other connected persons. So from my opinion, if those related party transactions are whether with free zone person or non-free zone person will be a qualifying activity. And there are certain other examples which you ask about excluded activity, like any banking activities or financing activity, leasing activities. So those are classified as excluded activities.
So, thanks Manoj for that. I mean, it's very essential for one to understand that manufacturing, why they have, made it a qualifying activity. The reason is that the entire United Arab Emirates wanted to promote the manufactured product out of UAE, and considering our regional GCC regions out there, where you see that everybody is trying to bring out manufacturers to the town so that they can add a lot much weight to the economy itself. So that is number one. Why the banking being an excluded activity? Because bank, whether you operate out of free zone or you operate within the mainland, the function remain the same. They continue to serve to the, the customers within the UAE itself, and they also pay, kind of taxes out there. So they essentially become, because the substance is within the UAE itself. So, on that same question, I wanted to ask you, I mean, when we talk about the qualifying activity, right? So qualifying activity, one of the activity is that distribution. And a lot of people in the UAE, they are basically dealing into distribution of the goods because ultimately 90% of the product that is get consumed in the UAE is basically imported. So when you look into the import from outside, then that too essentially over 80 to 90% of the goods are being imported out there, right? What was the reason for putting this as a qualifying activity number one? And who will actually qualify? So the concept is like, DG and non-DG. So DG stands for designated zone and non-DG is basically any other free zone. So what is the differentiating criteria in that relation?
See, basic idea here is that we now have a framework within which government wants to give certain benefit and do not want to give benefit across the board. So they had to draw certain criteria. Now, how do you define that certain? And that's why the DG and non-DG distinction, So they said, okay, because designated zones are the free zones, which have custom fencing, where inflow and outflow of goods as well as people is controlled technically. And therefore, if you are operating in and from that designated zone and carrying on this distribution activity, then we give you the benefit. Right? Now, what happens is that, yes, we all know that UAE is not only supplying to the local domestic market, but also supplying to a lot of other countries outside and all of that. And a lot of these businesses are based in free zones. But if they are not in the designated zone, then they are not likely to get the benefit of the taxation or the concessional tax rate, as we call it,
So let me just ask one question too. I mean, we have a lot of audience out here. So how many of you understood this distribution being a qualifying activity applying to the businesses? Please raise your hand. You understand that? And you totally understand it, there is no question. Then I'll ask the next question and see that how your reaction goes out there. So how many of you understand this entire distribution as a qualifying activity? None?
We have also not understood.
Nobody understood? Okay, very good. Because this is where the state of affair right now is, right? So all the panelists, right? So I'll start with, by you. The question is, within all of free zones, what people do that? They do high C sales. And high C sales is basically one. So you buy the goods from X country, you sell it into Y country. Good does not touch the shore of UAE, right? That is one transaction. And what they do that, they earn the trade income on that. But that is out and out. We understand from VAT it is out of scope. But will that be out of scope from a corporate tax perspective? That is question number one. Now, question number two is that, you have goods coming out from DG, which is like happen to be a designated zone, and then goods comes out to another free zone. Goods lying there, goods sold, does not move out there. How does it seem? I mean, you need not to absolutely answer about it. I just want to make the audience understand that, look, what is the complexity involved into this? Because I'm sure about it, you'll be having
So look, these are complex ideas because they are trying to create a threshold, a regime within which it applies and within outside of which it does not apply. It creates an issue, right? Now, we have lots of companies which are doing high sea sales, but as long as they are not touching the shores of UAE, can you call that operation having been conducted in and from a designated zone? Because that's the technical language, right? Now we are bound by the language to see whether we fall within that ambit or not. It's very as simple as that. Then there's one more layer of argument that, okay, if I'm outside the designated zone, I can't even think of claiming it, right? Because I'm not covered. Now if I'm inside the designated zone, can I still say that I'm doing that activity from and not in? And does that qualify me? So, I mean, these are all questions that we all are also grappling with.
So the point is that, look, this time when the law came out, that's what I started with, like more ministerial decisions, the more complexity, then more tiny bit of understanding and interpretations lies out there. So this is the first time in the UAE law that in and from becomes so important. This in and from becomes so really, really important for people to understand, and everybody is confined within that boundaries as to what, right? So, Tan, what's your thoughts around this?
Well, exactly. Now, it's not only decisions that are coming out. I believe that it's preferent for companies that do such trading to apply for a clarification as soon as possible, because this needs to be clarified. And like that, when you looked at the law versus what was intended, there may be some discrepancy. So someone needs to apply for clarification, in my opinion, and the FTA will grant it and will publish it. It will be a public clarification for sure, because it's an extremely important aspect.
How about your thoughts, Manoj, on this?
Yeah, so I would like to just add one point here. It says distribution of goods in a designated zone or from designated zone, and the customer whom you sell, it has to be for resale. Either they can process it, part of process it, and So just say hypothetical example: you are a Samsung in UAE, and your customer in US who is hotel basically. So you are selling few LED. Exporting your LED to hotel industry in US. So is it for resale? Is it for this is for consumption, right? So you need to understand your customer also at the same time. That is it for business purpose or is it for consumption? So these are, this is my takeaway that from one of the point that for resale you have to really understand your customer. Yeah.
Okay. So one last question I just want to ask. So I'm sure you're sitting out here all the, as the opening remark when we have the CEO from Khaleej Times, he's saying the trillions of dollars sitting out here in form of finances, managing the finances out there. So I'm sure you all have investments, right? And many of you will have in real estate investments, correct? Yes or no? Yes, right? So are you clear that, the income that you're making on your real estate, which is rental, is subject to corporate tax or not? Are you clear? Yes or no? Yes? How many yes are there? Only 2, 3. Right? So rest all are thinking that corporate tax will apply, not apply to them. Neeraj, what's your thought on that? The point is
if it is individually owned, you go into exemption.
Yes.
Okay. If it is corporate owned, it is taxable, provided only exemption being that if you have a commercial property in the free zone, which is lent to a free zone person, then only you get 0%. All the rest are taxable.
But my question is not that simple. Understand that. Why I ask this question? Because they all are waiting for that. So there's a small word that is written at the end. Should you not require to obtain the license? So what I did is a little bit before coming here, because I thought the panel is going to be there. So I went to the Department of Economic Development website and I tried to find out, look, is there any service out there? And guess what? I found there's a service lying there, which says that a professional license is required to lease or maintain the self-owned property. Guess what? So now there is a license activity lying in Department of Economic Development out there. And the law says that, your real estate income is subject to exemption. Should you not require to obtain a license to conduct that activity? So what's your thought, Tyne, on this? Do you have seen that, right? The question
I have seen that. I believe the intention is that for individuals who buy residential property, and again, I think it will become clearer as time goes on with that activity, you don't need an activity if you've got 3 or 4 units and you're letting them out to residential people, you yourself. So I think the idea is not to tax them. However, if you are now a individual who's running a company where you own 50 properties and that is your sole purpose, and not necessarily own a company, that is your activity, then that's what you will be taxed on. I think it will be clarified later on, as my colleague said, if you're an individual. Right now, unfortunately, what we can tell you is that if you're an individual, you're not liable. But as you said, you need an activity.
Manoj, what's your thought?
I agree with Tyne. It's more to do with a business activity. As an individual, maybe you can own more than 100 properties, but you need to see the purpose of the uses of the property. Say you have given a residential property to your tenant, which is okay, but if you convert it into holiday home, say, or Airbnb, or you converted your property into a hostel, okay, so then the question arises, it's a business activity and you have to take license and you conduct.
Well, thank you. Thank you so much, panelists out here, Manoj, Neeraj, Tyne, to share insights on that. But friends, I want to tell you one thing, that though there is a lot of ministerial decisions out there, we have seen the list, we have discussion so much around it, but still there are a number of apprehensions out there which is in the market, which you need to understand on your specific scenario and transactions. And essentially, if you deal out of free zone and mainland and you deal into the properties, you deal into investments, do take appropriate measures, understand, read word by word, line by line, relate the sections to understand your own positions, that where exactly you stand, because this is something which is very crucial, because you're going to be parting your income. Should you not understood the law precisely, out of your income, there's a cut that is going out to the government. So many times business ask you what we should do. I think it is a great time. Trust me, it is a great time for those who really eye expansion. Because today you can expand your business and 10% of that cost can be compensated, by the government itself in form of corporate tax rebates. Because when you start a business, not necessarily in the year 1 or year 2 you make the profits. Those profits can be set up against your existing, those losses can be set up against the profits. So essentially, technically, you can expand your business significantly in much more larger ways. So see the opportunities lying out ahead of every business in wake of corporate tax. So thank you so much for being here, and so nice audience out there. Yeah, thank you so much.
Thank you.
Thank you.
We are now moving to our networking break, and thank you so much to our panelists for the fantastic conversation. We have some very informative sessions that will be lined up and coming up on the compliance requirements, capitalization rules, and the importance of upgradation of skills. And definitely not to forget that we have a really interesting activity at the end, which is the Dubai Drums activity at the end of our conference. So I'd like to invite you all to the networking break, and let's regroup again after 20 minutes. Please enjoy. Thank you. All right, so welcome back, and I hope you've all had a wonderful networking break and got a chance to do some good business connections. I want to go once again, and thank our sponsors, Crow, Anderson UAE, Tax Guian, ACCA Middle East, Taxation Society, Unicus, IVAS International, El Tamimi and Company, MCA Consultants, MIC Technology Services, MIC Tax Services, SBC, Tally, Interlinks, Fame Advisory, and BSA, definitely for supporting us. Let's move on to the next session. This one is very interesting and has been carefully put together to explore the regulatory landscape and definitely delve into the essential compliance consideration and equip our attendees with the knowledge and the strategies to navigate the complex world of corporate tax compliance with our next set of panel discussion speakers. I want to welcome here onto the stage Vijay Mohan, a managing partner, IVAS International. Ashkan Parpinshi, sales and marketing director, Crow UAE. Nandiraja Chitti, senior country manager, Tally. And our moderator, Venkatesh S., managing partner at MCA Consultants. Let's all please welcome them to the stage with a very big round of applause. I also want to add one more speaker, which is Pratik Tishwal, partner MIC Technology.
Hello. Good afternoon, everyone. Always a challenging session, either before the session or after any break or before the break, just to keep the attention of everybody. And you all had a heavy of corporate tax and what is all the different dimensions. Now we'd like to see in this session what all to be complied as in basic things to be complied by the business people as well as how the technology. So we have veterans from tax professionals as well as technology players in this session, because we all keep seeing now from 18 the VAT, what all the compliance to be done, or ESR, AML. In this wave now we have corporate tax in a big way. I remember Sadhguru was saying in 89 years back, no tax, nothing. How come thousands of chartered accounts a year? Now all these have started coming and we can see more and more professionals engaging in the tax practices. Equally, it's also become more responsible for each professionals because they have to give the right advice to the clients. Now this session will cover on the compliances and technology. We have Vijay, Nandaraja, Ash, and Pratnik. I'll start with Vijay. You can brief on what all the compliances requirement, what has been announced for any taxable person under UAE corporate tax.
Thank you, Venkatesh sir, for that question and opportunity to speak in this panel. Actually, when we talk about the compliance, this is the outcome of all the works which we do. We talk a lot about international taxes, transfer pricing, and tax structuring and all these things. But end of the day, by complying to the regulations is the most important part with respect to fulfilling all the conditions of corporate tax law. So when we talk about the compliances, I would like to start with the registration process. This is the first compliance part to comply with the corporate tax regulations. So all the taxable person, other than certain exempt person which is required to be registered. Even though there is no time limit prescribed, all the taxable person required to be registered for corporate tax. The second compliance after the registration, along with the registration, we can see there is a article for deregistration as well. So within 3 months, when the entity or a natural person who conducts a business, or if a juridical person, if he stops business due to dissolution or a liquidation, they have to file a deregistration application. So that's all the registration and deregistration compliances. Second thing, what I would like to add is that maintenance of the books of accounts, which is more crucial and most important aspect in complying with the corporate tax regulations. As far as the books of accounts is concerned, actually after maintaining, the article says that there should be all the supporting documents should be available for whatever the returns and documents you filed with the authorities. And also, the articles further specifies that whenever the authority asks for that, the supporting document should be able to provide a correct calculation, and the authority should be able to calculate tax correctly based on the documents and information which you are submitting to it. So the books and books of accounts is the most important aspect, maintenance of the books of accounts, and this books of accounts needs to be maintained for a period of 7 years from the end of the tax periods. So that means effectively these books of accounts need to be maintained for a period of 8 years from the relevant tax periods. So that the technology partners will have more points to be added towards that. And with respect to further compliance, the audited financial statements needs to be maintained and prepared and kept ready for a turnover which is having more than 50 million as per the cabinet decision. And also further, there is a transfer pricing documentation requirement. If the company is part of a large multinational group wherein CBCR regulations are applicable and their turnover in any tax period is more than 3.15 billion turnover, then or the local or those companies which is not part of a large M&E, but their local turnover is more than 200 million, they need to maintain the proper transfer pricing regulations in place. Also further to that, there is a tax return filing is required to be done within 9 months from the end of the relevant tax periods, and the due tax is also need to be paid within 9 months. So those are all the compliance regulations which, as far as the corporate tax is concerned, still now it has been published.
Thank you, Vijay. And in this now, because of the compliances and become new, the technology also plays a very crucial role in streamlining the process, because we know many people books maintain in the manual and Excel and all those things. So Ash, I would like to ask you, while it is relatively feasible for big business to invest into IT infrastructure, how can SMEs take the steps towards adopting technology in UAE? And what are the critical requirements that as a business owner one shall invest into?
So first of all, I want to thank Zaid Bey, our managing partner, and Nimish, our senior partner, and the Khalij Time team to having me here. Regarding your first question on which step we should take to prepare for it. So we advise always our clients to as first step, to have an ID map that aligns with the company business strategy. The second step that we advise is to look at where technology can make the biggest impact and relieve the pain the quickest. The third step that we ask to our clients is to evaluate technology's options that will scale up as your business grows. So usually with the right consulting partners, you get planning, you get change management, and execution, which for any size of company, especially for SMEs, is key to maximize your financial investment and lower the risk of these projects. Regarding your second question, which is what are the critical requirements that as a business owner one shall invest to, we aim to think that obviously a strong and transparent financial accounting software. I heard earlier a person talking about ERP. So ERP is the core and it's the most important. We at Crow have different ERP solutions that we work on. My team focuses mainly on Oracle NetSuite, a cloud ERP, built many, many years ago. And these solutions, no matter what the solutions are, these solutions should be able to help you automate your processes. The solution should be able to build business rules, approvals, and so on, remove WhatsApp, remove emails. And this solution should be able to help you with the real-time data. They should be able to help you to manage the multi-company transaction, multi-currency, multi-countries, and as per my colleague Vijay mentioned earlier, all these new regulations will impact transfer pricing, corporate tax, and this solution should be able and should be ready to do so. Especially for SMEs, the last thing that I want to mention, that is this investment should quickly make a difference for business owners, because rather than thinking about their compliance, about their promise, they should be thinking about how
they can grow their business. Thank you.
Thank you. Thank you, Ash. Over to Nandaraja. We have been hearing a lot about the awareness drives and being your tally man in the corporate tax. How can SMEs benefit from such awareness programs, and how the tally and what you are doing in this regard?
Thank you. See, now Vijay mentioned about importance of bookkeeping, or let's say record keeping, and Ashkan mentioned about the technical aspect of it. Now, we focus both of, and the most important, apart from these two, what we focus is inducing required knowledge for the SMEs, especially. Now, compliance is something very new for this country. It's not, fairly 5-6 years. During the VAT time also, one of the primary objective was how we can be part of the compliance journey with SMEs. So what we did is we did around 300 plus knowledge sharing sessions with various platforms, and we could reach out on 13,000 plus customers during that time. So again, we are back with the same thought process. During VAT also, what we did is we introduced something called as Compliance Maestro in association, or let's say with the support of some of the tax experts. I think some of you are already sitting here. Now, again, how we do it, we run this program with various platforms. It could be through blogs, articles, seminars, and radio shows. One of the radio show which is going very popular now, that is, I think, almost we completed 32 episodes. Again, this is again, we are going to continue for next few months as well. So now, every episode we come up with something new on the subject matter. Especially on the corporate tax. So I request all the business take advantage of this. Again, this is absolutely, these sessions are absolutely free. So businesses can take advantage of this.
Thank you. Over to Prateek, to maybe now is also about compliances. Is there now, because we have seen in VAT a lot of penalties, deadlines, the returns to be filed within the 28th and on those. What has all been now announced yet on the deadlines and penalties, when what all to be done, as we said, any restriction, the dates fixed for corporate tax registration, when the return filing, how the applicability, within how many months, and which all the companies has to file for a corporate tax registration?
So, as Vijay mentioned, there are no specific fines and penalties as on date that has been announced. But what is important is we need to register as soon as possible. We need to file our income tax return 9 months from the end of the financial year. And what is also important is the record maintenance, because everything that will be defined, all the fines and assessments or penalties that will come in the due course will be depending on the books of accounts that you have maintained. The FTA can always ask to produce the books of accounts today. Transfer pricing plays an important role, so all the documentations, master file, local file, all the documentations becomes very important. And just to clarify, or just to add in, who needs to register for corporate tax? I think anyone and everyone except people or sole business establishment, natural person, below a threshold limit of 1 million will have to register for corporate tax. And that is why it is very critical that we be prepared. And FTA has already started with mainland. A lot of free zones have also received for registration. So we should start our process today, not delay it. However, said that, there is no deadline as such which has been defined as on date. Thank you.
Thank you, Prateek. And further, like we mentioned about books of accounts and maintenance, now it's basically about accounting, which accounting standard, what methodology, what method to be adopted. Many people, as you said, we never maintain accounts. Now they need to start maintaining accounts. Can you elaborate on that?
So accounting has to be on the global standards. IFRS is important. So we need to maintain our books of accounts that way. Apart from that, what is also important is, accrual or cash basis. That is something that we need to take a call on. And lastly, what is also important is when the books of accounts is being done, who is required to get it audited, which becomes a very important part. And there is a threshold for 50 million, but not for free zones. So free zones have to compulsorily get their books of accounts audited. So that has been defined, and I think, we are in the right direction. And in the due course, there'll be a lot more to talk about.
Thank you. Having said about free zone, And now, like, no, how can business optimize their corporate tax position by leveraging free zone effectively? Is there any opportunity? We have seen a lot of mystery, and people earlier they used to think that no, whether to move to free zone, the export business and things.
So technically, by reading the law as on date, this is my personal opinion, I feel 90% of the free zones will be under the corporate tax purview. However, the FAQs may come to our rescue in terms of the export business as well as the high sea sales. But today, if you ask me, anyone in the free zone, apart from doing local businesses in the free zones, will be under the corporate tax purview. And it may be a major hit to the lot of free zones that have been established in the region, because not only that happens, but the qualifying free zone loses the opportunity of tax grouping, or small business reliefs. So that is why when I was speaking earlier as well, I said, if a free zone entity earning 2 million dirhams as as a total turnover, should they opt for tax, corporate tax, because they have at least 3 million small business relief. But yeah, as on today, before the FAQs, I feel 90% of the free zones will be under the purview of corporate tax.
Thank you. Vijay, having now advising many clients and all those stuff, what will be your one advice to everyone sitting in the audience today on what to be taken care in the corporate tax?
With respect to corporate tax, we need to have a very proper planning on how the corporate tax is going to be affecting the business, like an impact assessment. What are all the deductible expenses, non-deductible expenses, the payments to the connected persons, and of course the second stage is the maintenance of books of accounts, which I give more emphasis towards that, because being in a local market which was not regulated much. So we do maintain the books of accounts in the fashion which we wanted. Even group of entities, wherein we have 5 entities are there. There are many groups which we make only one set of books of accounts. But when corporate tax comes in, the registration is based on the entity wise. So you have to produce and file the returns based on the entities. So separation of the books of accounts is become very crucial. So the proper planning, understanding the requirements, understanding the law, how that law will be affecting the business, make changes according to the requirements and comply with the regulations. So that will be the most important things. And we are going to be a fully regulated market, and wherein we have seen from the last 5 years, we are in the field of practice. So how drastically the compliance requirements has been changed. So now all the informations relating to a company starting from ESR regulation, corporate tax, VAT, excise tax, and everything going to be in one portal called Emira Tax Portal. And the second, one more option, thing will be how do you reconcile all this return with your books of accounts? And you are going to file a corporate tax return. And after the corporate tax return, obviously you are going to, from the accounting profit, you are going to find out a taxable profit. So the reconciliation should be maintained in a proper fashion. The carry forward of losses, the carry forward of interest, and the reconciliation of the VAT with the books of accounts. So all these things will be going to be very crucial. And of course, the financial statements also will be required to be submitted for the corporate tax purposes with the portal. Now, for the VAT purpose, you are just filing the tax return, saying that this is my turnover. But later on, this reconciliation will be one of the crucial part of it. So by that time, you should be, all the entities, business entities should be ready to answer the queries of the authorities. So that would be the most important thing with respect to that.
Thank you, Vijay. Maybe Nandraja, maybe from your perspective of your small businesses with the technology aspect, what will be your advice?
Yeah, there are two things. One is like, let's say, Pratik mentioned about the implications on free zones. Likewise, now let's say tax filing period may be very far from now, or let's say the registration window is open for a long. But at this moment, I think every business should understand the implications of corporate tax and bring in the required structural or let's changes or amendments in their business process. That is number one. Number two is having the right set of software for making this process simplify, or to simplify this entire process. Now, software alone will not help to simplify the process. First, you need to understand and bring in certain changes, then definitely the softwares, be it any of, but it will help you to streamline this process. So first, we need to focus basically on your structure or the amendments required.
Thank you. maybe Ash, from your perspective on the technology and what should be your advice?
Yeah, so I might be a little bit repetitive and boring, but I will mention exactly what Vijay and Andaraj said. Right now, we all heard about all these sessions, about the changes, the regulations that are coming up, and this is going to affect our daily operations. But this doesn't mean that other countries in the world have not done it in the past. So our advice is to really start exploring, evaluating softwares, evaluating advisory firms from now, because what we feel is that maybe the cost of starting now will be less than the cost of getting fined later on. And we always push, sometimes we might sound pushy, but the reality is that it's best to plan, it's best to have a strategy starting now, because soon we'll have to be prepared.
I think, just to maybe a particular point, morning we saw a lot of about the tax group and what is to be done. Somebody to decide before what is to be there, to go as a tax group or not, what would be your precautions, what is to be taken care, and your thoughts on that.
So with the tax group structure, I feel that what is important is to analyze that compliance or one return is more beneficial, or taking the the limit of 375,000 dirhams is more beneficial, because if you have 50 entities or 100 entities, that is a substantial amount. Considering transfer pricing also is exempt, it will be a very cautious call to be taken, and that is why, like the peers said, what is very important is probably do an impact assessment as on date, see where you are as a group, and take a cautious call, because you can group the entire structure and be more productive in terms of setting off the losses as well as compliance burden and all, or you keep the compliance burden and take the benefit of 375,000. But this can only be happening if you take a cutoff date, understand where you are as an entity today, and then take a call, because you know your growth strategy, you know your expansion plans. And if it is aligned with what you are doing today, it'll be very easy to, take that call in the near future rather than taking it next year. So that is why these 6 months are very, very critical in terms of finalizing whether tax grouping is important for your entity or not. So that's what my thought is.
Thank you. We have one last question to Vijay. Now, in the morning, we also another topic on the substance, and many free zone entities are there, and all those where there's whether to how to know whether the substance and what would be advised all the companies which been formed here and not having officers much, or whether now the flexi desk is only there now, the way to make an office space or people employed on those lines. That is also becoming a compliance.
As we said in the earlier qualifying free zone discussion, substance will be the most important thing in order to qualify a free zone, to be a qualifying free zone person. The substance, as per the cabinet decisions, it requires enough office space. Also, the people should be employed, and it should be the core income generating activity should be from that area wherein you have been registered. If that is not been done, then of course you are not going to be a qualifying free zone person. That free zone exemptions is not going to be available for you. So that's very clear. I think substance is going to be one of the crucial and important part of it, because it stops the base erosion and profit shifting, which is one of the core important topic for OECD to comply with all the regulations. And UAE, if you see that OECD guidelines, it has been widely accepted, all these regulations very openly. So I would say that this will be one of the steps to stop that BEPS issues. So the substance will be one of the core area which needs to be satisfied by all the entities.
Thank you. I think we have done with the questions. If the floor have any questions for the panel. Thank you. Thank you all. Thank you. Thank you.
Thank you. Thank you very much.
Thank you.
Well, thank you so much to all our panelists for taking the time to share their knowledge and expertise with us. Now that we have a better grip on the compliance requirements, let us now move to the deduction under the UAE corporate tax and the thin capitalization rules. This session will be conducted by Vijay Mohan, a managing partner, EVAS International. So let's all please call Vijay onto the stage with a big round of applause.
First of all, thank you, Khalid, for this opportunity and organizing such a big event, New Age Finance and Accounting Summit, and giving us an opportunity to talk in front of such an audience about the corporate taxes. The session, actually, we have gone through many sessions since morning, and it was so technical. And actually, this is really a practical session, which is how do you calculate the tax. How do you calculate? By calculating the taxable income, certain deductions and certain important aspects of deductions, so certain deductible expenses, what are all the deductible expenses, and certain points which is relating to the deductible expenses. That is the point which we will be covering on the session. So first of all, we know that the tax is being calculated based on the, starting from the accounting profit. So we do certain adjustments to the accounting profits to arrive at the taxable profits. And while calculating the accounting profits also, there are certain expenses which we book in the books of accounts as an expenses. Certain of these expenses are not deductible for the corporate tax purposes. So that is the point in which we will be discussing about it. So the expenditure here, which will be classified as two categories. One is the deductible expenses, and the second one is the non-deductible expenses. So these non-deductible expenses are part of your accounting profit or accounting income, but that will not be, that needs to be adjusted in order to arrive at your taxable income or taxable profits. So what are all the non-deductible expenses? And then we go to the deductible expenses. There are certain categories of expenses which require special treatments. So what are all those treatments which is required for those kind of expenses to be deductible? One of the important example is that is interest. Interest expenses, which requires a lot of conditions to be satisfied to be allowed as a deductible expenses. So we will be going into detail about it. So first half we will be discussing about what are all the non-deductible expenses. So these expenses which will come and sit in your P&L as an expenses, but for the calculation of taxable income, these expenses needs to be added back. First one is the donation, grants and gifts, which we pay to any unapproved charities or any unapproved organization, whatever we pay, so that we need to add it back. And then fines and penalties, bribes and other illicit payments, dividends and profit distributions, which has been paid to the business owner. And if there is any withdrawal from business by a natural person, any corporate tax paid, any input VAT, which would have been recovered, but unknowingly or knowingly, the input VAT has not been taken into consideration, and that is sitting in the profit and loss account. So that input VAT which was recoverable, otherwise it was recoverable, which has not been taken into consideration, needs to be added back. Tax on income paid or payable outside the state. So if you have a foreign permanent establishment, you pay some taxes, or if you have some withholding tax outside the country, which we cannot be taken as a deductible expenses for the calculation of taxable income. And if there is, other than that, by cabinet decision, minister can specify any other expenses which is going to be a part of it. So these are all the list of expenses which can be a part of your accounting profit, but for the purpose of calculation of your taxable income, you need to add back these expenses. So now comes to deductible expenses. What are all the deductible expenses for the corporate tax purpose? So the expenditure which is incurred specifically and exclusively for the purpose of the business is deductible expenses. Other than those which is in the nature of capital nature. So if that expenditure, if that expenses which you incur is capital nature, you need to capitalize those expenses and then take the amortization based on that. So if that expenses is in the nature of capital, then you cannot take it into the P&L. You have to add back that capital expenditure, and then the depreciation or amortization will be allowed on that. There is special treatment allowed, special treatment prescribed on entertainment expenses and interest expenses. And also, if you have expenses which is incurred, which is in the nature of personnel, and also some portion is on business nature, you have to allocate that expenses based on the nature of expenses. And there are two expenses which the corporate law prescribes special treatments. The important one is the entertainment expenses. Entertainment expenses, whatever we incur for the customers, shareholders, suppliers, and business partners are allowable only up to the extent of 50%. But if these entertainment expenses are incurred for our own staff, then that expenses is fully recoverable. And also, what is the entertainment expenses? Expenses in the nature of meals, admissions, accommodation, or transportation, which is incurred specifically for the purpose of shareholders, suppliers, or the customers, then that expenses will be allowed only to the extent of 50%. So now the next category of expenses which we need to discuss is the interest expenses. Interest expenses, usually whenever corporate tax law specifies about the interest, it always talks about the net of interest. So when we talk about interest, it means interest expenses minus interest income what we earn. And interest normally is deductible based on whenever you are incurring that interest, it is deductible on the period in which it is incurred. If you look at the corporate tax law, there are many sections which talks about interest. So what is the reason of interest being talked a lot about in the corporate tax law? If you see that Article 29, it talks about interest expenses. Article 30, there is an interest limitation rule which has been prescribed. Article 31, there is again a specific interest limitation rule has been brought in. And there is a ministerial decision came in, which number 126 of 2023, that also prescribes about and discusses about the interest. So what will be the reason for interest being discussed so heavily? Because interest is being used as one of a tool to shift the profit from one region to the other region. The loan is availed in a region wherein high tax rates are there, and loan is being funded to the another company wherein into a low tax jurisdiction, and the high tax jurisdiction company gets a dividend out of that. Then actually dividend will be taxed in a much lower rate. So interest is being a tool to shift the profit from one region to the other region, and that is the reason why there are so many sections has been introduced in the UAE corporate tax law also in order to limit those transactions. So if you carefully look at this, all these regulations has been taken out from the OECD guidelines, so which we will be coming into the later slides. So what are all the conditions of interest, which we can take it into the P&L account, from the P&L to the tax calculation? So based on Article 29, normally the interest is deductible in the period in which it has been incurred. So what are all the general interest limitation rules which has been prescribed in the law? So there is a fixed ratio rule. Fixed ratio rule says that you can take only up to 30% of the EBITDA as an allowable expense of allowable interest deduction. What is an EBITDA? Earnings before interest, tax, depreciation, and amortization. So only up to 30% of the EBITDA you can allow as a taxable, allow as a deduction for tax calculation. And then there is, based on the Cabinet Decision 126 of 2023, there is a minimum rule has been prescribed. So if your interest expenses is up to 12 million dirhams, then you don't need to apply the fixed ratio rule. So you can take whatever expenditure you incurred as an interest expenses. So if your interest expenses is less than 12 million, you don't have to apply the fixed ratio rule. That is an important decision which has come out as per the Cabinet Decision 126 of 2023. And there is a carry forward. If you are having
12 million interest, more than 12 million interest expenses in any year, and you have some carry forward provision amount as per the fixed ratio rule, then this interest expenses can be carry forward to the next 10 subsequent years. And these provisions are not applicable to the banks, insurance companies, and natural persons. The natural person is an important category, wherein these exclusions are not applicable to the natural person. And this rule is not applicable to there is an exclusion for this fixed ratio rule for group of companies, wherein you are required to prepare a consolidated financial statements. Then you can use the group ratio rule instead of the fixed ratio rule. Group ratio rule is nothing but what is your group EBITDA divided by the group interest expenses. So you have to apply the group EBITDA. Group EBITDA is the group total interest expenses divided by the group profit, group EBITDA. So you can apply that percentage instead of the fixed ratio rule. One more thing you need to be careful about is that when you apply the group rule, this is not as per the tax group or any other VAT group which has been prescribed as per the corporate tax law. This is if you are required to prepare a consolidated financial statement as per the IFRS regulation, then you are required to apply the group rule instead of the fixed ratio rule. So these are all the general interest limitation rule prescribed for the corporate tax purpose as per the corporate tax law. Now there is a specific limitation rule has been brought in. If you are taking a loan from a related party and that loan is being used for any of these below purposes, then your interest expenses cannot be allowed as a deductible expenses. You are taking a loan and repurchasing shares of a related party, and you are taking a loan and paying dividend out of that, and you are taking a loan and putting this as a capital contribution to a related party, then these amount of loans, whatever the interest which you incur on this amount, will not be allowed as a deductible expenses for the corporate tax purpose. And also the rule says that if such, if you can prove that this loan is not being taken for a corporate tax advantage, then this amount is an allowable expenses. So I wanted to ask you one question at this point. So what will be the main reason for introducing or implementing all these rules and regulations in a corporate tax like UAE corporate tax law? It's a very simple in nature. And what will be the reason for implementing 3 sections only on interest limitation? It is mainly because your undue corporate tax advantage people are taking because of shifting the borrowing from one country to the another country and to regularize the related party borrowings. And there are, related parties are being funded unorganized way. So they wanted to regularize the related party borrowings and to secure debts and managed more transparently. So these are all the main reason for implementing these 3 regulations in the corporate tax law in the UAE corporate tax. So now, when we talk about the interest, there is one concept which will come widely is the thin capitalization rule. So actually, if you look at what is a thin capitalization, these rules are being developed from the thin capitalization rules. It is on an academic aspect, which I wanted to add it to your knowledge. Why these rules are being implemented in UAE corporate tax law? These laws, these articles are implemented in order to control the debt financing than equity financing. People are using the debt financing as a tool to invest in the funds rather than investing through the capital. Because of the people are investing through the debt finance, people will take undue tax advantage. Actually, usually the interest is an allowable expenses, but whereas dividend is not an allowable expenses. So people uses debt financing as a tool to save the taxes on it. So in order to avoid that debt financing, thin capitalization rules has been brought in. And because of that, thin capitalization rules has been also been taken into the UAE corporate tax law. So is this shifting of interest from one region to the another region, whether this is an allowable expenses, related party fundings are allowable expenses, and is this a transparent way of tax planning? Actually, it is a very good tax planning, but OECD says that it is an unethical tax planning. So they wanted to stop that unethical tax planning, and because of that, these rules has been brought in to the UAE corporate tax law. And UAE corporate tax law widely accepted the OECD guidelines. And because of that, all these regulations has been in place in the UAE corporate tax law. If you look at it, the OECD guidelines, there is a specific section, Action 4 of BEPS action plans, which has been prescribing only about limitation of the interest borrowings. So UAE has been widely accepted that action plan into the UAE corporate tax law, and then they have brought in all these restrictions and regulations into the UAE corporate tax law. Usually OECD approaches, there are two approaches. One is an open market approach. They will look into the arm's length pricing, and then they will be looking at there will be some fixed ratio rules has been implemented. So 30% of cap, 12 million de minimis threshold, or carry forward of losses, all those things are the fixed ratio rules. And these two rules has been widely accepted into the UAE regulations, and they have been accepted into the corporate tax law. Now, these are all the fixed ratio rule the OECD guidelines has been prescribing. That is, the first one is the de minimis threshold. That means the 12 million threshold which has been given in the corporate tax law is the de minimis threshold which has been prescribed by the OECD. Fixed ratio rule, which has been prescribed as per the OECD guidelines, which has also been taken into consideration. And there is a carry forward rule, which has been given. And there is a group rule, which has been given if you are a part of a multinational group. And there is a specific exclusions and specific rules addressed to specific conditions also. So all these regulations, all these rules which has been prescribed by the OECD has been taken into consideration of the UAE corporate tax law. So how tin capitalization in UAE is being approached? So it is predominantly taking the fixed ratio approach, and then there is a hint of open market approach and specific interest limitation rule. So if you look at it, the UAE corporate tax law, there is a specific general interest limitation rule. The first one is the fixed ratio rule, which has been prescribed by the OECD. Second one is the de minimis monetary threshold. That is a 12 million, which has been prescribed. So below 12 million, you don't have to apply the fixed ratio rule. So that is the de minimis threshold, which has been prescribed by the OECD. And then 10 years of carry forward of losses. So interest expenses, if it has not been considered as an expenses. So 10 years carry forward is the provision which has been come from the OECD regulations. And then banks and insurance, there is a specific exclusion. And there is a group ratio rule. If you are a part of a multinational group wherein you are required to prepare a consolidated financial statement because of the statute or because of the IFRS requirement, instead of the fixed ratio rule, you can apply the group ratio rule. So you have to apply what is the group EBITDA comes in, or group ratio EBITDA interest to the group profit, what is coming in. And instead of 30%, that ratio can be applied for you to calculate the percentage of interest which can be allowed as an expenses. Now there is a specific limitation, interest limitation rule is also brought in into the UAE corporate tax law. That specific interest limitation rules restrict the related party borrowings, which is used for the purposes other than purposes which has been mentioned. Because if you are financing a related party, then that specific interest limitation rule will be applicable. So that is the coverage of the interest expenses. Interest expenses is one of the crucial expenses which is you need to be aware about it while doing the tax planning and calculation of the taxes. So these are all relating to the interest expenses. So on the way forward, what are all the things which we as a finance professional, what we need to look at it, whether there is a proper terms of arrangement is there, when there is a related party borrowings is there. So what is the total interest expenses which can be allowed in your calculation of the taxable income, how the interest expenses can be carried forward for the future years, and what will be the disallowed expenses for the calculation of the tax payable. So these are all the things which will be taken into consideration while calculating the taxable income and while calculating the interest expenses as in general. And this is the total of deductible expenses and non-deductible expenses. And with respect to deductible expenses, there are special provision for entertainment expenses and interest expenses, and that is the one which we have covered. If there is any other questions relating to the interest, we can discuss. Thank you. Thank you.
Well, thank you very much to Vijay. Your contributions have definitely enriched our understanding of the topic at hand. Let us now move to the conversation before lunch on transfer pricing and significance for corporates. Let us hear from our speakers on transfer pricing, what it is and how it works, and some recommendations for all our businesses. I'd like to invite onto the stage our speakers. Harshita Raju, Manager, International Tax and Transfer Pricing, Crow UAE. Mithilesh Reddy, Senior Partner, Transfer Pricing, SBC Tax Consulting. And Rajiv Hira, Managing Partner, RHMC Consultants. And our moderator, Dinesh Jangid, Regional Managing Partner at Unicus Consultec. Onto the stage, please. Let's all welcome them with a very big round of applause, please.
Okay, so after very exciting conversation on corporate tax, let's move a little bit onto transfer pricing, because that's another important element of the overall tax compliance. And if you look at the high level, transfer pricing regulations require all the related party transactions or transaction between connected parties to be at arm's length. That's like the very broad principle to start with. And then obviously there are a lot of other requirements around, let's say, free zones. We have had a lot of discussions around free zones. And for companies under free zones to be able to maintain their 0% tax status, I think they need to be compliant with transfer pricing regulations. So I think for this conversation, we have a very good panel of speakers here. So let's start with Harshita first. That from compliance point of view, what are the key things that the corporation, the UAE, need to be aware of from transfer pricing standpoint?
Good afternoon, everyone, and thank you for having me here. So as you mentioned, the first and foremost requirement of a transfer pricing regulation is that any transaction that a taxable person carries with a related party or a connected person have to adhere to the arm's length principle. So what it essentially means is that the pricing for the transactions that you undertake with a related party has to be at a market value as if those transactions were undertaken with an unrelated party. So while this is a basic requirement of a transfer pricing, it also imposes TP documentation requirements for the taxpayers. But while arm's length principle will be applicable for all the persons that are subject to the corporate tax, Unlike the requirement for compliance with arm's length principle, the documentation will be applicable only for those taxable persons who have a revenue exceeding AED 200 million or an entity that is part of a multinational group with a consolidated group revenue exceeding AED 3.15 billion. Only such entities will be subject to mandatory maintenance of TP documentation. So TP documentation is a requirement under BEPS Action Plan 13, wherein it includes a three-tier documentation requirement, which is a country-by-country reporting, master file, and a local file. So as we all know, country-by-country reporting has been in existence in UAE since 2019. So the additional documentation requirement that is given under the corporate tax is maintenance of a master file and a local file. So just to give an overview of what exactly would go in the master file and local file. So the master file gives a overview of the group wherein you will have to give the group ownership structure and what are the business activities of the group and what are the intangible that it holds and what are the financial arrangement that a group has. And the local file that would give a more detailed details of the local entity, which comprises mainly of the industrial analysis, the economic analysis, and the functional analysis. That is the core thing for determining the arm's length price for the related party transactions. In addition to the documentation requirement, corporate tax also requires the taxable persons to file a related party disclosure form. So this is an annual filing requirement, and this related party disclosure form may have to be filed along with the annual corporate tax return that a taxable person is required to file. But however, as on date, there's no clarity on which category of taxable persons would be subject to mandatory filing of related party disclosure form. That's all is relating to compliances that a taxpayer should be mindful of from a transfer pricing perspective. Thank you.
Thank you, Harshita. It's quite clear. Seems like there's a lot to be done by companies and corporates here. Let me then move to, I think one of the key thing that I heard through the day is from transfer pricing point of view, documentation is very, very critical. And that's how you're going to be able to justify the pricing that you have for transactions between related parties. So for that, let me come to Mithilesh, to you, that what are the key things that people sitting here and in wider audience need to be aware of from documentation standpoint? And what are the core methods would you prescribe?
So, good afternoon, everyone. This is Mithilesh here. So, I mean, before we move to the documentation aspect, there are 2-3 things in terms of the references is what we wanted to highlight first. The documentation aspect, as per the Ministerial Decision 97, it's talking about 200 million AED. But in terms of the transfer pricing requirements as such, if you see, right from audit mandate of 50 million, that, what I'm trying to highlight is not just the 200 million above category where the, TP documentation requirement is coming, but from, qualifying free trade zone basic condition, it's a requirement. From, transitional provisions also, it's a requirement in terms of, opening balances, in terms of tax groups, in terms of qualifying groups, in terms of business restructuring reliefs, wherever there are references of arm's length, market value, and the fair market values are coming into picture. There are almost around 8 to 10 important provisions which are talking about this documentation requirement. So Article 55 and Ministerial Decision 97 clearly requires the documentation, and wherever there are cross references of 34, we should categorize the documentation into 2 parts, internal documentation as well as the local file documentation. From a compliance angle, what we are doing is from the local file, master file, and disclosure form. But in the next 6 months to 1 year, I think most of us should be working on the internal documentation. So the internal documentation should be like, identifying the related party transactions, TP policies, benchmarking reports, intercompany agreements. Those form the basic fundamentals for the transfer pricing documentation in detail. So the point that I'm trying to tell you is the segregation of the internal documentation getting organized and then moving on to the compliance aspect might be the next phase. Now the TP documentation, they have kept a mandate of 200 million AED, but in terms of the components of TP documentation as such, identifying the related party transaction, the group overview, entity overview, nature and terms of the transaction with the related party, industry overview, and then the functional analysis, identifying the most appropriate method. As sir was saying, there are 6 different methods of transfer pricing. Comparable uncontrolled price method, profit split method, transactional net margin method, other method, cost plus method. So there are almost 6 different methods. But when what is applicable are, should be identified for the relevant transactions and the relevant industries. So most probably, even the UAE government, from a FTA assessment standpoint, might move to industry margin analysis like the world is revolving around. Maybe TNMM might be the most preferred model. But if we have internal comparables and if we can document the third-party transactions well within our group or within the entities, then that will play a major role in the benchmarking analysis. Now, coming to the economic analysis part where the 6 methods are coming, the conclusion and the clarifications and the form is yet to be announced. The components of the local file and the TP documentation are yet to be announced. There are clarifications around arm's length range that is not yet announced. There are clarifications on the preferred databases that is not yet announced. There are, a lot of things which still require clarity in terms of usage of multiple year data versus single year data. So, all these questions are still there, but from a TP documentation standpoint, the major components and methods is what we need to analyze and understand the facts and arrive at conclusions. But most probably it might be TNMM at the end, because all they want is taxes, which is based on profits and what you are and what the industry is working on.
Yeah, thank you. Maybe I can ask a follow-up question. Practically speaking, a lot of the transactions that we see commonly are, let's say, intercompany loan. So if you come across such transaction, what is the best way to getting to, let's say, arm's length pricing or an interest rate? Any tips on that?
In terms of the financial arrangements, mostly loan transactions or the debentures or the financial instrument transactions, the most important question will be the timing of the issue of that element of instrument, what we are talking about, the loan. The date of the transaction, credit rating of that particular entity, lender and borrower, the geography in which both of them are situating, the currency in which they are operating, and there are various factors. All this, when we put it into the search processes or the databases that we use for transfer pricing, Loan Connector is one of the most preferred database which we use. So when we actually punch in those details, the similar industry, if you are able to get similar industry comparables in terms of the financial arrangements, then the interest rates comparability will be very, very easy. But if you have internal comparable in terms of having your own financial arrangements with any banks or any other third-party transaction where you are having interest rates which is clearly available within your facts, then that becomes a challenge. So you have to be very, very clear in that data or interest rate setting in the beginning itself. Yeah. And of course, the thin capitalization rules also come into picture. Yeah.
And I guess the other thing is this whole definition of related parties and connected persons. There's an entire accounting standard under IFRS which deals with related parties. So do you see any diversity that might happen between, in financial statement, what you're showing as a long list of related parties and what you will end up categorizing a related party from TP standpoint?
So the IAS 24, sir, I'm not an expert on IFRS, but the IAS 24 versus the related party definition that is there in the decree, the connected person definition that is there in the decree, that is 35 and 36 articles. They talk about 50% direct and indirect holding and the ownership management control kind of a definition. And there is a significant influence word also. This particular significant influence is prevalent in your IFRS that you put it in the RPT schedule directly if you see the significant influence. But this significant influence word is not defined in the decree, in the UAE tax law. So that is very, very important. Even back in India, there is a deemed international transaction, deemed related party kind of a definition, where they have given a list of 12 to 13 different scenarios where you can identify the deemed relationships. But here, I don't think they have defined it clearly. Maybe they'll come out with clarifications. But the point that I'm trying to tell you is, if somebody is getting audited, that might be a qualified free zone person or above 50 million kind of people where IFRS is coming to picture and related party schedules are being done by you guys, then definitely those have to be considered and you have to take it up for benchmarking and reporting purposes. Definitely the disclosure form, once it's announced, the type of related party, connected person, and the benchmarking analysis, the kind of method that you're using, all these questions will be there in the disclosure form. So the RPT schedule versus the RPT disclosure will be a significant component.
But I guess you can start with there. That can be a good start for you to look at which are the entities that get covered.
Especially for audited clients. Yeah.
Okay, I think one of the questions that everybody must be interested in knowing, Rajiv, is what are the tools or areas of tax planning that companies can consider? So any tips from your side?
Dinesh, before I giving tips, I think Harshit and Mithilesh has covered up the full transfer pricing. So that's a good part. But I always say that rather than looking at what to do, why we are doing it is understanding that is more important. Because why transfer pricing? Why corporate tax? Why all those schedules which you are waiting for regulator to come and tell us? I think that there is a lot more need to be done before that itself. So TP is the last, I will say, the leg. That's basically more a documentation framework. So there is a struggle, there is a common framework to bring up the international tax transparency coming into the framework of compliance. I think that's a key. Why someone has to do so much of documentation for transfer pricing? Because they believe that we may be overpricing or underpricing a product or a services to shift a profit from one entity to another. So that's a core. So I think before we get into a documentation part, first we need to start introspecting each transaction. Whether are we doing the right thing or we are having some kind of a biasness. That's what the arm's length and all those jargons comes into play. Am I keeping the person under arm's length to have a transaction? So I think that's a core activity. And I go back to the favorite subject I keep talking, like tax cannot be studied or cannot be looked at a standalone basis. We need to look at tax and compliance. And when I'm talking compliance, I'm not only talking about tax compliance, I'm talking about AML compliance, I'm talking about how the transactions are executed within the country, domestic, or even cross-border. So those angles need to be looked at. Now coming to the point on, can we do a planning? Yes, we can do a planning. Now, in UAE, it's a very unique market. I always say we cannot compare this market with any other space. We have seen companies where one company is only a pure cost center and the other company is the pure profit center. So, and the mix and match of those things are happening where maybe because of labor employment, I had resources sitting in other company, but whereas my revenues are coming in B company. So is there a mechanism we look at? Can we group those companies? Can we look at adding both the companies in such a fashion or create such a group that we don't have to look at TP in a larger scale? So if I have a group company where I know this is my cost center, this is my profit center, because of some various reasons I have done so, can we make that as a part of a same group? So my all transactions which are done are looked at from a group perspective. So there is no documentation things which comes into play. I need to definitely look at accounting side, but we need to look at how those things are done. So just to give you a very basic example, when you do an audit, we, from a VAT perspective or review the accounts from a VAT perspective, we see expenses are booked. Okay, can I see the invoice? Yeah, invoice was raised in company A. Then why you're booking in company B? So I'm saying the basic accounting itself has to be looked at before we get into a TP framework. So my first take is, yes, there is a planning required. Whether the planning has to be reassessing the transaction itself, reassessing the grouping structure itself, so that we don't get into the framework of how things are getting misappropriated. There is a lot of discussion with everyone, including us also. Internal documentation is important. Yes, we agree. We have seen regulatory authorities, I'm not talking only tax, they come and just sit on your, let's say, on your PC, laptop, whichever systems you are using. And the keyword searches are used to identify what kind of communication is happening internally. So we need to be very cautious and we need to be very practical on how the transactions are executed, talked about within the organization, documented within the organization. So documentation always does not mean creating a dossier or a separate document. It can be internal communication also. But had we elaborated what we want to elaborate, had we penned down what we want to say, if you are not able to, then I think that itself is a gap. Imagine you are doing a transfer pricing document, everything, and there's a communication. How can we save taxes between these two companies? So it's an interesting point, right? So it itself takes me to the anti-avoidance principles, rules, and all that stuff. Forget about transfer pricing. So we are getting into a completely different direction. So I think planning ways, definitely we need to get our team accustomed to the new normal, which I keep talking about from a UAE perspective. And it started somewhere in 2017 when legal framework, legislations, VAT, ESR, all those frameworks started coming up. So we need to get into a compliance mode. Do we have a manuals? Do we have a compliance manuals? Do we have a fair purchase policy? Do we have a client onboarding policy? Do we have a mechanism of putting up how we do a tendering process? How the POs are accepted? Do we have those basic documents? If no, then whatever you create from a transfer pricing perspective, which Mitlesh has very rightly said, there is always a dent in the process. So my view goes is a very decent discussion. Before even authorities come back and say that these are the forms, these are the activities which need to be filled in, there is a lot of pre-work which is required. Had we started. So coming to seminar is good, but going back and doing some homework is also important now. Last point which I want to say here is, there are two events, I'll just give you a perspective. One, there is a marriage function or a birthday celebration happening, and the second, there is a war happening, right? So these are two events. Now, I want to use something. I have two assets, or you can say two stock items to be used. One is firecracker and a weapon of mass destruction. Where should I use what? Should I use a weapon of mass destruction in the wedding and the birthday party, or crackers in the war zone? Answer is no. So I'm saying selecting a system, selecting the tools, selecting the work, look at what kind of a size we are. If a simple software is helping you, don't look at a ERP. If ERP is a need, don't look at a simple software. So accounting, even looking at something as basic as whether we use a Tally or a Oracle or a SAP or whatever product we use, all are unique product, all have their own prepositions, all have their own dynamics. We need to look at what is needed by us, rather than looking at, no, this is the best system. Maybe best system for someone else, but may not be for me. So similar thing applies for a documentation. One thing which I learned from Mithlesh's previous session also, you cannot copy a transfer pricing document from any other client. If you're trying to do it, I think we are getting into one disaster mode. So every company, every entity, every structure will have their own risk, will have their own compliance framework, and has to frame up the document based on that. You don't need to be I'm saying rocket scientific person to draft a document. Start writing what you are doing it in a compliant way. So that's, I think, a longer answer, but that's what I want to give. Look at the genesis also. Documentation is important, but genesis, base work, groundwork, foundation stone is more important than anything further we take it up.
Great, thanks a lot, Rajiv. So I guess the main thing is if you have, depending on the structure, if you have structure whereby you have various different entities doing cost center versus profit center, I think the whole reorganization and restructuring is going to be very critical before you actually get into the tax period. So I think that's really very important that we heard. So good tips, Rajiv, thanks a lot. So maybe I can open up that question to the other panelists as well, that are there any couple of recommendations you want to give to the group here and people hearing from elsewhere? What are the 2 or 3 tips that you want to give or recommendations you have from transfer pricing standpoint? Rashida, let's start with you.
Sure. So transfer pricing is something which has a broader implication. So it has interaction with corporate tax, it has interactions with indirect tax. For instance, in corporate tax, for a free zone to be eligible for 0% tax benefit or a tax holiday claim, it has to mandatorily comply with the corporate transfer pricing requirement. Similarly, for an entity that is entitled for a small business relief, while it has to comply with the arm's length principle, it may not be subject to transfer pricing documentation. Considering that TPs, it's not as simple as we discussed right now. Raju mentioned that me and Mitlesh, broadly covered everything that is there in the transfer pricing. But it's not really as simple as it looks like, and the entities have to start acting because the corporate tax is already effective. And given the fact that, the opening balance sheet, that is the financials of 2023, have to be drawn up in compliance with arm's length principle, the entities have to start assessing, start mapping the transactions that they have within the group, see which entity is doing what, have right agreements in place. assess if the current pricing policies that they have been following, meets the arm's length price. If not, implement a policy in place that will help entity to, prove or substantiate that the transactions that they are undertaking with related party are, in essence, is at market price and meets the arm's length price requirement. Thank you.
Okay, Mithilesh?
Yeah, so one important thing that I wanted to highlight is there is no tax audit here in UAE, sir, interestingly. But the point is, wherever we are, doing the compliance or about to enter into 1st January 24, the most important thing that we need to keep an eye is on the thresholds, deductibility. TP is there in almost around 8 to 10 sub-references. So even in tax computations aspects as well, 134 MD and 2 section, Article 2 subclause 20E. So that's how it is. So they are specifically referring to adjustments on related party transactions even in the tax computations aspect. So, and there are transitional rules which ask you to maintain the opening balances on arm's length. There is a myth going on in the sense that if you adopt for tax group, transfer pricing is not applicable. But there is a specific article which talks about the tax members computation, which says that each tax computation of the member individually, when you're doing it standalone basis, it needs to be at arm's length for referencing to specific scenarios. So it has to be created internally. The discipline has to come internally before we go to the next year, 1st January 24. So this 6 months are very, very important. And also from an overall perspective, the compliance tracking and the readiness for 1st January 24 is what we need to work on. So that's it, sir.
Thank you, Mithilesh. And Rajiv, you have the last word. You anyways gave a lot of tips, so if
I think
there's anything you want to add.
One point which I say everyone, which we have seen in the financial industry, creating a risk-based register, creating a risk register. So I'm not sure which organizations are creating that risk register, because if you're not having a risk register, technically speaking, we don't have a tip of what can go wrong. And if we don't know what can go wrong, we can keep dozing off one fire and the second and the third one, and keep running behind the consultants internally and externally to dose the fire. And to be honest, water is very scarce here. And consultant charge very differently when you come on the complete fire zone.
Fair enough. You're one of the consultants, so I heard you charge very differently when it comes to dosing the fire versus normal compliance.
Definitely, there is nothing wrong, because if as a doctor, when there is a OPD different charge and the ICUs are different,
excellent.
Why not for us?
Fair enough. We have a couple of minutes for any questions that the audience may have. Anything on transfer pricing?
I think law is very clear.
I guess you guys have been very, very clear. So thanks a lot on that note. Thank you, everyone, and thanks for your patient hearing, everyone. I hope you found it useful. Thank you.
So Dinesh, apart from tax, we save time also.
Time saver, absolutely. Thank you.
Well, thank you so much for our panelists for the very fruitful discussion. The CT law has just been implemented and is expected to evolve in the coming months and years, and hence it is the utmost importance right now that we need for the continuation of learning and development. So let's all now invite onto the stage the last panel discussion for the day. And it gives me great pleasure to invite our speakers. To start with Stephen Ireland, Head Tax Creation Business Consultants, and we have Noman Mian, Chief Financial Officer at Bait.com. We have Olina Swain, Global Head Tax at IFCO Group, and our moderator, Fazila Gupalani, Head ACCA Middle East. Let's show them some appreciation with a big round of applause, please.
Right, so I know I'm keeping you between your lunch, which I'm sure you've been sitting here since morning with a couple of coffee breaks. So it is my pleasure to be here today to deliver a session which I think this slide needs to change at the back of me. Thank you. And this session is all going to be about upskilling and the importance of upskilling and supporting tax professionals. I've been speaking to a lot of recruiters in the region and employers. And one thing for sure is there's not enough tax professionals equipped with the experience and the knowledge to do the role here. And employers are demanding and wanting more tax professionals. 40% more roles are available now than there were last year in the area of tax. And therefore, I am honored to be here with this panel, fantastic panel, Noman, Stephen, and Alina. Right, so I will start with ladies first. How crucial is upskilling for tax professionals in ensuring effective implementation of corporate tax strategies? And are you able to share just a couple of examples of how upskilling has positively impacted the corporate tax outcome, or it might be the VAT outcome, because that's the lessons learned, right?
So thank you so much for having me here. At IFCO Group, we operate around 49 jurisdictions. So corporate tax is not new to us, but UAE corporate tax is new. So when my team advise internally before somebody comes in and says, oh, can we do this, can we do this, can we change this value chain, can we do something different, my team had to think about how will impact somewhere else, right? So what other tax jurisdictions will be impacted and so on. Whereas now I have to ensure that my internal team knows what impact it will have in UAE and think about that. So how we talk about not just UAE corporate income tax impact, we talk about our international tax impact, and of course then Pillar 2 comes in and overlays this in the next year and a bit. So a lot of my time spent educating my team, making sure my team attends the courses, make sure my team speaks to advisors, so that they have skills and they can advise the business. The other things which actually came kind of internally and hit us is that we implement new IT systems. We do lots of automation, this new words, let's make sure everything is automated. If we don't know what the impact it will have on us in corporate income tax, then the systems will be set up incorrectly. The forecasting will be done incorrectly. It impacts everything. So, as I said, lots of my time is done training. In terms of the examples, I've said every day somebody will come to my team and say, what if we do this? What if we do that? And what if we change a value chain? Transfer pricing, of course, arm's length, cross-border transactions, double tax treaties. And then you say, okay, so this all status quo only for a year, because Pillar 2 will come in and hit us again. So a lot of thinking, a lot of upskilling. We spend loads of our time, and I do ask my team internally as well, book time during the week, 2 or 3 hours, attend the courses, speak to advisors, read, because we as tax advisors, our main job is read the law and then interpret it, okay? Different people will interpret things differently. So first thing, pick up the law, read it, then go and speak to everybody. But it's crucial. At the moment, it's absolutely crucial. Nobody have in-depth expertise in UAE corporate income tax. It's new. We have experience from other jurisdictions. We have to bring it in. We have to bring our practical experience. If you've done change in TP or value chain, you have to change your legal paperwork. You have to ensure that the tax authority is aware. Or, for example, there's any impact on APAs or double tax treaties or tax residency certificate. You have to think about everything when you're in-house, not just one thing. So we do it every day.
Fantastic, thank you so much. Noman, in today's rapidly changing tax landscape, why is continuous learning and development essential for tax professionals? And how can staying updated with these latest tax regulations and practices benefit both an individual and organizations?
Thank you, Fazila. I think you made a very valid point regarding learning. One, the law is new, which means that none of us are really the experts yet. So which means we are bringing our practical knowledge from prior understanding of previous laws, or if you have been applying tax in other geographies, then that's the learning that you are bringing in. So that's one. So either you had prior experience dealing with it, or you are going to be new at it, and now that means there's a learning path for you. So the question of upskilling, and updating, it's important, because it's like being on Dubai Road and have a Google map which is not updated. So if you have a situation like that, then probably you will end somewhere else rather than your destination. So it's really important that you keep yourself updated, find the way to learn. And being at this event is probably just one way, because this is where you'll pick up some of the items that probably you didn't know previously. But most likely your takeaway from here will be some of the key points, but the learning will actually come from possibly a certificate. And I know that ACCA has a UAE corporate taxation certificate. I think that would be one of the best learnings that you can get. And we talk about tax professionals and how 40% there is more demand, but really we are finance professionals who need to have this knowledge before you even sit in front of a tax consultant. It's like going to your doctor and not knowing what's wrong with you, right? If you are able to tell them what your issues are able to guide them how to solve them, and make sure that, or at least put your thoughts to them and tell them this is where the pain is, this is what I'm trying to solve, and they will be able to guide you better. Otherwise, they will spend 3 sittings just trying to understand your business. And trust me, no one will understand your business better than yourself. So if you really want to make an impact, go out there, do the learning, do that certification, so you can really say that you know what the tax law is about. And it will not just, it will enhance your expertise and skill set, as well as probably help you with your next role as well. People just don't become tax managers, unless they have studied it, of course. But half of the people who are really looking after tax, they don't really have a tax degree. They usually have a finance degree, which helps them. So make sure your learning and upskilling is really, really important for all of you who is in this room. Don't leave it to your consultant, and hope maybe all those consultants who are there will not like me now. But don't leave it to your tax consultant to tell you what to do. It's your job to make sure that you guide them and let them then make sure that they fit your business within the tax laws.
I loved those points. The tax laws are new. None of us are experts yet. Yes, and Noman is correct. The ACCA does have a UAE tax certificate that covers all aspects of tax, where the syllabus was worked on with the Ministry of Economy, and that is available for tax professionals, finance professionals. But I do like what you said, because we're all members of different bodies, right? But then if you look, you're specializing in tax, which means that every single finance professional has to understand UAE tax. So, Stephen, emerging trends and technologies. We can't actually do any panel nowadays without talking about technology, can we? Such a buzzword. But so we've got all of these emerging trends and technologies that are reshaping the tax industry. What new skills and competencies do tax professionals need to develop, and how can they adapt to these advancements and leverage them to optimize tax process and outcomes? Because I think Alina also mentioned technology, so it'll be interesting to hear your view there.
Yeah, no, thank you for the good question. At a meeting with a well-known business coach over 3 years ago, the the first thing he told me is that you may lose your job within the next few years as machines will replace tax specialists. But during this time, I was convinced of the opposite. In my opinion, we overestimate artificial intelligence and technological development. For example, a tax GPT portal, which is a project created by Virtuozone, which was launched last month, I think, where you can just ask a simple tax question and you get an answer. Perhaps for a small business with simple queries, this is enough, but where you're dealing with medium or large size multinational groups, which sometimes have more complex structures, you need someone that can assess the situation as a whole. So the conclusion is that Tax GPT and other technologies can assist you with the specifics of the UAE tax regime, and for example, can help you draft a memo, which will help you become more tax efficient, but you still need an international tax advisor to piece it all together and optimize the position of the multinational group, as each group needs to be assessed on a case-by-case basis. So let's come back to the question about emerging trends. There was previously a lot more competition, but these days I've seen a lot more collaboration between firms. Some tax professionals are focusing on specialist areas like transfer pricing, and collaborating with other specialists like IP registration specialists, for example, which is a win-win situation for all parties involved. So in my opinion, the new skills are the ability to collaborate and think global.
Ability to collaborate and think global. Right, ChatGPT did do a CPA exam a month ago and failed it. And then 2 weeks ago, ChatGPT did actually pass a CPA, which is the American body, exam. I'm wondering when the next news headlines will be that it passed an ACCA exam. And that's really interesting, a chat about Tax GPT. But so, and I'm going completely off script now on the questions, right? Because I find this really interesting. Have you put in questions and has it come out with accurate answers for the UAE? That's based on
I mean, to be honest, I've just put in like simple questions. When is a tax due to be filed, tax return due to be filed, and yeah, we've got the correct answer. But I've not tested it for more complex questions. But
yet.
Yet.
Okay, when you do, please do let me know how does it do.
I think they still need to update it.
Do they?
Because
okay.
it's all updated till September 2021. So all the tax laws for at least UAE is fairly new. So wait and watch.
That's correct.
That's
I tried
correct.
to test
So
it as well.
Have you tried it? I did have my neighbour yesterday message me a tax question because he saw me in the Khalij Times newspaper and thinks I'm a tax specialist now. I think I'll be putting that through Tax GPT and seeing what the answer is. Right, thank you for that. That was really interesting. Alina, so we know that in the UK, sometimes after doing a qualification, they have a CTA, the Charter Tax qualification, right? And a lot of people that want to go into that field might do the CTA qualification. What training and certification programs are available here in the UAE? And how do you think that these programs will contribute to personal growth and expertise? And I'm not sure if you can talk from your employer's perspective, but are you seeing the L&D teams investing and supporting with this really important topic that every single one person needs to know in a finance function?
So you're absolutely right. In terms of training, the jurisdictions where we had tax, they had loads of training developed. But in the UK, we have CTA and ADAT recognized as a kind of the tax, and I've done it to become a tax advisor. Here, I have seen a number of things popping up, but I have seen ACCA has developed the program, which I think is very good. And what I liked about it is that what they've done is, first, it's written by professionals. It's written with sort of review from Minister of Economy. But also, as we've seen, the kind of release of the law, it's happened in bits and pieces. So those courses that came to me and said, in December 22, when the law got released, we've got a course. And I'm thinking, well, there's still plenty of ministerial resolutions to come out. I cannot see how can this course actually give me insight to my team. Whereas now I can see, and I've been talking to my team as well, that they have to attend the course, that they have to have that knowledge. We have to know. And as you pointed out, is our finance team has to know, our tax teams and our legal teams have to have that knowledge of tax, because everything we'll do now will be impacted by tax. It's just become certainty of life in UAE. Corporate tax, not personal tax, but corporate tax for us and corporate. So what I've liked about the course that ACCA released, and please have a look at it, is they've done first part when the initial law got released, so the key bone of rules that they've taken into their course. But whereas now the kind of the latest ministerial resolutions got released, they've essentially taken reading it and interpreting and helping financials to understand what they actually mean. So this is really helpful. I will attend, my team will attend. I'm a leader. I have to show my teams that I'm investing in myself, that I'm investing in my team, and therefore we have to carry on learning. I don't know everything, and every meeting, my team laughs at me, but I do take the printout of a law, and I say, look, if I don't know the answer, I'm going to sit and look at it. So I think the important thing is trust the organizations who release these courses. Don't try to go into something that's been released before ministerial resolutions, because a lot of changes happened, and the law is not as simple as we thought it's going to be. So there's lots of nuances. So please, and again, MOF has been really helpful when they released the kind of those announcements saying, please, please, only trust sort of accredited bodies, only trust the actual law, the people who knows what they're talking about. So if there's any guidance that's written with Ministry of Economy, MOF, FTA, that's probably something you should rely on. Some other courses might be also good. Please continue learning. But all I'm saying is that if you are to invest in yourself, make sure you do it wisely. And something will pay off and add value to you, because we're not here to just stay in the same job all the time. We all growth, we want growth. Add value. There's a perfect time when it happened with VAT, perfect time to add value to yourself. We're in perfect storm. We're learning now. You can be so valuable when you add that knowledge, implementation of CT, doing all those courses, learning on the job is a great opportunity for everybody. So totally encourage everybody to just carry on investing in yourself.
Fantastic. So continuous learning, add value. It's for yourself, but it's also an investment for yourself and your organizations. Thank you.
Sorry, second thing. Yes, we will be paying for courses, so yes.
Fantastic. Noman, collaboration between tax professionals and other departments within an organization is crucial for successful tax implementation. How can tax professionals effectively communicate and collaborate with non-tax teams, such as what Alina said, it's legal as well. So it's the legal teams that need to be involved as well in order for the tax professionals to achieve the objectives and mitigate any risks?
Well, it's like an orchestra, right? So you need to make sure all your musicians are synchronized to ensure that you get the best result. Otherwise, the music will definitely be off. Be it tax professionals, be it any role that you have, the idea of your role is always to collaborate, right? If you cannot add value to your role unless you're collaborating. When it comes to corporate tax, yes, you as a tax professional and finance professional, you need to work hand in hand to ensure to get the best result. Now, how do you communicate is also important. You can talk about transfer pricing with the gentleman who doesn't know anything about tax, and you lose them in 1 second. So how does it work? It really works when you go down to the basic. You tell them why is it important for them? Why is it important for you to ensure why tax planning is important? So there, from a VAT perspective, corporate tax is slightly more different. VAT was more process-oriented, whereas corporate tax needs planning, right? Which means you should be working now on corporate tax rather than any time later. So in terms of planning, now, if you're trying to sell someone something, then you really need to show them that it's going to look best at the end and what it's going to look like. So in order to make sure that when you pitch that plan, you're pitching it for someone who will really understand what it's going to, or how it's going to impact them, right? For example, there are certain deductibles which are not going to be included. There's transfer pricing involved. Why is it important? Why you cannot be in a loss in an organization, whereas your other entity is in profit. So there has to be some logic behind it. And you need to really make sure that they understand it, right? And when I talk about collaboration, I'm not limiting it to maybe just finance. You need to have your CEO sitting in those conversations. Why? Because there probably is a company restructuring required as well. So when you say tax is your responsibility, it is your responsibility, yes, but it is a group accountability, because everybody needs to be really involved in the process to really know what is the outcome. Nobody wants to pay tax, right? So if you don't want to pay tax, that means you need to work well ahead and plan it, right? So that you don't pay more. I mean, you pay what is due, but you at least don't pay more than what is due from you. So that needs everybody on the same table talking about the same things. So leave all those section 204 and 5 out of those conversation, because probably none of the people would know which section you're referring to. Just talk the layman terms and it should really get the message across.
No one wants to pay tax. That's no man's final Barack Obama moment. No, you didn't mean that. I like the fact that you said that it's your responsibility, but it's also the group's accountability. And VAT was more process orientated, while corporate tax does need planning. And if you fail to plan, you're planning to fail. And I think that's the key takeaway with the whole VAT corporate tax implementation, is that you've got to prepare and plan. So, Stephen, looking ahead, what future trends and developments in the tax landscape do you anticipate? And how should tax professionals prepare themselves to navigate these changes effectively and capitalize on these new opportunities?
Yeah, again.
Is there going to be personal tax ever? Do you know?
I believe so, in my view.
Oh goodness, we're all believing.
It won't be for another 5 years at least.
Seriously?
But, the problem is you've got one of the neighbouring countries, Oman, that's introduced it, and what you normally see other countries eventually follow. But yeah, like I say, it'd be at least another 5 years. That's my opinion. I don't know. It could be wrong.
I actually expected withholding tax to come in
Sorry?
first. I think withholding
yes,
tax, that will come first.
And the way the legislation's drafted,
Yes.
they've made it easy to make that change, haven't they? So, yeah, because that was one of the big shifts, wasn't it, from the public consultation document, where they said there was going to be no withholding tax, and then the final law mentioned 0%, so they can obviously just change the percentage. Just going back to the question, so yeah, if you go back 5.5 years ago, the tax landscape was very different, as you only had customs duties, but now you have corporate tax, transfer pricing, country-by-country reporting, the economic substance regulations, VAT and excise tax. So yeah, like we just mentioned, I think we'll see the introduction of withholding tax and personal tax within the next 5 years. I believe that more groups will relocate their global headquarters to the UAE, so not just be a regional hub. We have already seen a core group which owns Fairmont, a hotel chain, relocate its headquarters from Paris. And senior management of the group are also living here in the UAE. There's obviously a booming hospitality industry here, but there's also still a very favourable tax regime, especially for headquarter businesses. So if you're a free zone and want to benefit from the 0% corporate tax, then it's important to maintain substance, which basically means having more UAE resident directors and C-suite here. So going back to the question about preparation, my advice when planning is to keep structures flexible so you can easily adapt your structure for any surprises, like we had on the 1st of June when the definition of qualifying income was released. It turns out that free zones are not as favourable as what we originally anticipated, and foreign income will now be subject to 9% corporate tax. So just to give you an example, one of my clients is a UK IT consultancy company which opened a free zone company in Dubai and was planning to use that company to invoice its clients and then close the UK company once they've relocated here. But because that income in the free zone company will now be taxed in the UAE, we're going to keep the UK business and basically badge the free zone company as like a headquarters and basically charge a management fee to the UK. So you optimize the position because you're stripping out a lot of the profit, and that will be a very efficient structure at the end of the day. So yeah, like I say, keep it flexible so you can easily adapt to any surprises.
I think you're just going to get an influx of clients for tax advice on how to restructure now. Was that the plan? Thank you so much. I think the key, what you've said there is, oh my goodness, if there is personal tax, I can't stop thinking about the personal tax element right now. I think most of us have left the UK for that particular reason, to live in the sun, sand and sea.
Yeah, I mean, it's not going to be as high as, 40, 50% what you see in UK and Europe. If they are going to introduce it, I believe it'll be,
2%?
Well, hopefully, yes.
Thank you so much. It looks like we've run out of time, but I think in conclusion, there's a lot to do. An individual has to take responsibility for it, and then the organizations have to also support the individuals within different functions, finance and tax. Upskilling is important. It is all new information. Go to the tax laws, go down straight to the basics, understand, comprehend, interpret. Go and ask your employers to support you with the upskilling so that you are able to have that extra skill set that you need in order to do your jobs. Prepare and plan, add value to yourself. And I love the analogies that you came out with, Noman, today. Google Maps in Dubai, the orchestra. So it is all about collaborating with different parts of the entity as well, an organization, all towards the sort of main goal, and getting the CEO on board in case there is any need for restructure. So, with 40 seconds, and that countdown is really going down fast, right? And I know I'm keeping you from your lunch now. I would like a round of applause, please, for the fantastic... You want to ask a question? All right, yes, so before the applause, should we just have one question?
Fazila, interesting conversation you have carried over, and thanks to Stephen also. But my question is to the industry right now. See, going to a very specific thing, having worked in Asia, Africa, and Middle East and multinational organization, I have a very simple question to ask for. When we engage with a professional, we talk about indemnity insurance. But when we talk about employees, their indemnity is only for 30 to 90 days, the notice period. We have seen that during the VAT era also. After 1 year, a lot of tax professionals switch their jobs, not because of anything else, because they know some goof up has happened.
let me switch before I change it. The basic question which I want to ask you is, with this landscape changing, compliance, taxes coming up, had you revisited the GeoJD of the employees from all perspective, not only for tax employees, not only the employees who are working in a tax division, looking at your perspective to get a context right?
It's payback time, right? Okay. Now, from VAT perspective, again, the idea of VAT was building it in as part of a process, right? So it impacts each and every transaction that you do, which means that unless and until you fix the process, you won't be able to get the real outcome. Now, the difference between the corporate tax and VAT is the planning aspect, right? So you need to plan ahead. Now, this is this is again that Google map. The planning will continue to update as the laws continue to update, right? The structuring really possibly needs to change as well. So definitely, from my perspective, the tax professionals or people who, the finance one have to be the tax professionals. Of course, you need the experts on your side, but really the driving force has to be finance at some point because they see everything coming in. And I have the bias because I'm in finance, of course. So, so in terms of understanding, everybody needs to understand. Everybody needs to view, because everybody has a different view of tax, right? And probably the destination probably would be the same, but the way to get there can be different. And for that, you need to make sure that, one, you have all the teams prepared for it, skilled, so whether the company pays or not pay, it is your duty. Your learning is your responsibility. Nobody is gone are the days when you had to ask your parents what you want to do next. You're old enough, you need to plan for yourself. You need to plan your learning path. You need to plan what you want to do next, right? Anything that you learn now is a skill set, right? You enhance on that skill set by probably do a certification or do something else. But that it is for it's an investment. And you will reap the benefit in the future. Now, when is a difference? It could be a 5-year deposit, it could be a 3-year deposit. It will turn out to be a benefit for you. So, from my perspective, it is a much longer journey now. It won't be like a VAT where people will, after 12 months, feel, okay, now everything is done. It's no longer a required JD role for someone. But I still feel it has to be part of everybody in finance to ensure that you're thinking about tax.
That's a lovely answer because for consultant, everything has to be done. For employees, no JD updation. So I like it.
You got your approval there. So thank you very much to Stephen, Alina, and Noman for taking your afternoon out to come here to talk about upskilling and training and the future of tax in this region. Can we all have a round of applause, please?
All right. So thank you so much for our panelists for the very fruitful discussion and a conversation. For our closing remarks, I'd like to invite onto the stage John George, Chairman ICAI Abu Dhabi. Let's please all welcome him to the stage with a big round of applause.
Good afternoon. I will not take much time. I am in between you and the lunch. Let me introduce myself. I am John George, I'm the chairman of the Institute of Chartered Accountants of India, Abu Dhabi chapter. It's my honor and pleasure to stand in front of you to give a keynote speech at the closing session. As you're aware that US implemented the corporate tax, and we are going through the phase of implementation. And the US implemented this corporate tax with a big objective. It have a far-reaching implication on the financial landscape, as well as the economic growth and investments. So going forward, whenever you take a decision, you look into the corporate tax aspects to take a decision. So that's how important it is. And we have learned a lot of things from today's session and great speakers. And this learning should continue. All are learning together. You know, it is a new tax in this country. And let's learn together. Let's have more conferences, exchange idea to make a better, how to improve our knowledge, our skills, to have file a proper tax understanding. And end of the day, you file a proper tax return so that you will end up with a proper, you can sleep peacefully at home. You know the penalties if you file a wrong tax returns. If you know the penalties if you misguide or if you are not transparent. So it's very important that you be transparent with authorities while doing your job to make sure that follow your ethics so that you can sleep peacefully at home. And the responsibility of accountants has increased. Earlier, you have to just finish your accounts, nobody cares. But now there are people looking at you, and just take as a word of caution that be very cautious, employ good people. If you should not mind employing good people by paying higher salary, but you should educate your employers saying that this is the top priority now. And any transaction which is going to affect the corporate tax again, you need to approve that. I mean, you should vet it. The reason because the implication will come back to the finance guys end of the day. So this education, you should have internal meeting with your teams. You should educate your department heads, your management, how important the corporate tax is going to affect the entire organization and the entire employees. So this is a very important thing. And I'm not going to take much of your time. And one of the things I just like to, we already heard from our speakers that the technology is something which help you to come with accurate numbers. So if your numbers are not accurate, if you don't have a proper accounting system, if your the accounting policies or IFRS followed is not correct, so this is all impact your tax returns. So I request that you bring a good, improve your technology, improve your ERP, so that you get a good tax return, a computation, which will easily flag out certain expenditure which can be disallowed, certain income which need to be taken out to be reported. So this type of exercise, you should do it now so that you are free. As I said in the beginning, the end of the day, when you're doing a job, end of the day, go home and sleep peacefully. This is required to keep your technology intact, spend some money on it. I think this is, at the end of the day, you should educate your management how important corporate tax. You need to spend some money, put some budget, hire some good consultants so that we reach the same objective. Again, let's have more discussion. Let's grow together. We have seen this because while implementing VAT, we had a similar situation. We were new, and we learned. And there are some challenges still there. About some few guidelines came, again some more is waiting. So that things will get clear shortly. I hope that we will able to do our job and justice to our work and have be able to learn to make a good tax return. I'm not taking your time again. Similar event, I'm really excited to see this event, great speakers, good audience. We are going to collaborate with College Times and going to do a similar event in Abu Dhabi. We are inviting you. The dates will be announced soon. And all the best and great learning. Thank you very much. Thank you very much.
you, John, for your closing remarks. We now have been waiting for the most exciting part of the day. We have a